If you're new to Forex trading and don't know where to start, this is the only complete Forex trading beginners course you will ever need. By the end of this course, you will understand what the Forex market is all about, have a fully verified trading account, and have placed your first trade. This is a 3 hours, 40 minutes beginners Forex trading course, and we'll be covering what Forex is, how to choose a broker, opening your trading account, taking your first trade, understanding charts, and navigating the TradingView platform. This free beginners course teaches you the basics and gets your trading account set up. If you want to dive deeper and learn my trading strategies, trade management, and complete trading system, that's available in my academy. I'm Sesan and I've taught over 6,000 students how to trade Forex. Alright, let's dive in. So if you're new and want to get started with Forex trading, the beginners class is the best place to start, okay? So in this course, the beginners class is meant to help you get started with Forex trading, giving you the basic understanding of Forex trading in the Forex market and what you need to put in place in order for you to start trading, okay? So the beginners class is made up of 6 different sections or 6 different topics. The first being an introduction to Forex. So here we're going to teach you what the Forex market is all about and what Forex trading is all about. So in the next section, we're going to talk about currency pairs and trading sections. So here we're going to show you what we actually trade in the Forex market and the different timeline across the globe in which the Forex market is open to traders all over the world. So that's what the second section is going to be all about. In the third section, we're going to talk about Forex brokers. So without Forex brokers, there's no trading for you, okay? So without Forex brokers, you simply don't get access to the Forex market for you to take those trades that would eventually make you profits or losses, okay? So I'm going to show you what Forex brokers really are, how to make profit, how you make profit, and why you really need a good Forex broker. So then we're going to talk about setting up a trading account. So I'm going to show you the different criteria and the documentations and everything that needs to be met in order for you to set up your trading account for you to get started with trading. Then we're going to talk about taking your first trade. So I'm going to show you how to take a buy trade, how to take a sell trade, as well as how to calculate your profit. Okay, so all these I'm going to be teaching you in the beginners class. And lastly, we're going to take a look at a brief introduction to the TradingView platform, which is an essential part of everything you'll be learning in the intermediate class. So just a quick rundown. The beginners class is meant to help you get started with trading, okay? It's meant to serve as an introduction to the world of Forex if you are a new trader. And as you move on with the beginners class, some of the sections are going to contain quizzes. So try as much as possible to take these quizzes to test your knowledge to see how much you understand the content being taught in this class. So if you have questions, use the question section at the end of each section or at the end of this class, okay? Remember, our communities out there will be readily available to answer your questions, to guide you, point you in the right direction if the need arises. So that's it briefly for the beginners class. Remember, it's just to help you get acquainted with the world of Forex. So a brief introduction to Forex and the criteria needed to be put in place in order for you to successfully get started with Forex trading. So this is the first section in the beginners class. So in this section, we'll be taking a look at a brief introduction to what Forex is all about. So you're going to learn what Forex is all about. You're going to learn about the Forex market and understand what makes up the Forex market. And then you're going to learn about the way profit is being made in the Forex market. So I'm going to teach you how profit is being made in the Forex market. And lastly, we're going to talk about why you have to learn to trade Forex, okay? So I know there's been a bit of a controversy over this topic or this question as to why I learn to trade Forex. So I'm going to try as much as possible to give you a fresh perspective of what I think and why I really think you should learn to trade Forex. So that's briefly what this section is going to be all about. So just to give you a brief overview again, we're going to talk about what Forex is all about. We're going to talk about the Forex market. We're going to talk about why you should learn to trade Forex and how profit is really made in the Forex market.
What is Forex? Forex simply means foreign exchange. Therefore, foreign exchange is the conversion of one country's currency to another. In this lesson, we are going to discuss what Forex trading is really all about, how Forex trading works, and how we make profit. So, what is Forex trading? Forex trading is the process of converting one country's currency to another. or the process of buying and selling foreign currencies. Imagine living in the United States where the official currency is the US dollar. If you travel to Germany and Europe where the official currency is euro, you would need to convert your US dollars to euro because in Germany you have to spend euro, not US dollar. The moment you convert or exchange your US dollars to euro, you've practically engaged in Forex trading. So, before we jump into how we make profit in Forex trading, let's take a look at how it works. The value of a country's official currency is tied to various economic factors and the demand and supply of the currency. If a country's economy is doing great, the strength of the economy is reflected in the value of its currency, making it stronger. And if the economy does bad, it results in a weaker currency. This is where the exchange rates come in. An exchange rate is the quantity of a currency required to buy another currency. If the exchange rate between euro and US dollars is 3.0000, this means you need 3 US dollars to get 1 euro. It also means the euro is more valuable than the US dollar. And if you were to purchase 1,000 euro, you would need to spend 3,000 US dollars. That's how the exchange rate of currencies in Forex trading works. Forex trading works based on the changing exchange rates between two currencies. Finally, how do we make a profit? Forex trading involves two different currencies, and profits are made from the changing exchange rate between these two currencies. The logic behind making profit in Forex trading is buying currencies when they are cheap and selling when they are expensive. So imagine being broke on a Monday morning and the exchange rate between pounds and US dollars is 3.0000. This means you need to exchange 3 US dollars to get 1 pound. Then you decide to borrow $300 from a friend and exchange the $300 for 100 pounds. You now have 100 pounds in your bank account. Now it's Friday morning and the exchange rate between pounds and US dollars has increased over the week to 6.0000. This means you now need to exchange 6 US dollars for 1 pound. You remember having 100 pounds in your bank account and decide to exchange it to US dollars at the new exchange rate of 6 US dollars for 1 pound. After the exchange, you now have $600. When you pay back the borrowed funds of $300 to your friend, you'd be left with $300. The $300 you're left with is your profit from the trade or exchange you made on Monday. There you go. That's exactly how you make profit trading Forex in the real world.
So I believe the animated video clearly explains what Forex is all about. Before we move on to the next lessons, I just want to make a few important points. Now, Forex simply means foreign exchange, which involves the exchange of one currency to another. Meanwhile, Forex trading is the act of actually converting one currency to another. So ideally, this is how Forex trading works in the offline world. But what you'll be learning in our academy has to do with retail Forex trading, and there's quite a big difference. Now, in the offline world, in order to make significant profits or life-changing gains, you need to control a huge sum of capital. But that's not the case for retail Forex trading. And I'm going to explain with this simple example. So let's say the Forex market was to make a 1% move in a day. In the offline world, for you to make a profit of $100, you need to control currencies worth at least $10,000. But as a retail Forex trader, you can actually make the same $100 profit controlling a $200 balance or a $300 to $500 balance. This is made possible with the use of leverage. But I'm not going to explain what leverage is right now because you're going to learn that as you move forward with the academy. So what I want you to understand is that for retail Forex traders, we have advantages and edge over the Forex market compared to, people engaging in Forex markets in the offline world. Meanwhile, in the next lessons, we're going to talk about the Forex market and who makes up the Forex market. If you have questions, guys, use the question section at the end of this course. See you in the next lesson.
In this video, we're going to explore what exactly the Forex market is, how big it is, who's involved in the Forex market, advantages of the Forex market, and how to join the Forex market. So, what exactly is the Forex market? Think about an actual marketplace with buyers and sellers exchanging goods and services like books, furnitures, car rentals, and so on. The Forex market is similar to this marketplace, but the difference is currencies are being bought and sold. Because it involves the exchange of money, the Forex market is also referred to as the financial market. So, by definition, the Forex market is a global marketplace or network where foreign currencies are being bought and sold for the purpose of making profits. This brings us to the next question. How big is the Forex market? Globally, over $5 trillion is used to trade the Forex market every day. This makes it the world's largest financial market. $5 trillion. That's a lot of money. Just in case you're wondering why the Forex market is so huge, here's why. Money runs the world, and all the big guys are involved. Central banks are kings of the Forex market. Money production and exchange rates are influenced by their decisions. Then we have governments, also big players who work closely with the central banks. The third group on the list are big investment corporations, commercial banks, and businesses around the world. And lastly, retail Forex traders like you watching this video. These big players are involved to make profit by taking advantage of the $5 trillion flowing through the Forex market daily. And you can too. Now, let's talk about some of the advantages of the Forex market. The Forex market is open to everyone with the experience to participate. There's no limit to how much money you can make. Very little startup capital is required to get started. As low as $10, and the market is open to traders 24/5, Monday through Friday. Lastly, here's how to join the Forex market as a Forex trader. You have to sign up at a Forex broker to get access to the Forex market, and because Forex trading is done on the internet, you'd also need a computer or a mobile phone and an internet connection. Lastly, you'd need some capital and most importantly, some trading skill.
The Forex market is the world's largest financial market. This is because over $5 trillion flows through the Forex market every single day. This is one of the reasons why the Forex market is larger than both the stock market and the cryptocurrency market put together. It's also another reason why so many traders around the world want to take advantage of this market, because there is so much liquidity and money flowing through this market that you could actually make a lot of profits and no one would notice. Something very important to take note about the Forex market is that it involves the big players. What this means is the government, the central banks, and large financial institutions are all part of the Forex market. Yes, retail traders are part of the Forex market, but we are kind of like the least in the food chain. So if you want to connect yourself with the Forex market and get involved with trading, there's a few steps you need to take. The first is you need to sign up with a Forex broker or a trading firm. So these brokers and trading firms are responsible for connecting you to the Forex market. But you don't need to worry yourself about that right now, because we're going to teach you everything about Forex brokers, how to, create an account and set up your account for trading. Meanwhile, you also need a good laptop, a good internet connection, or a mobile phone. But preferably, we recommend, having a good computer. You also need to have a little bit of startup capital to get involved with trading. Lastly, there's something very important no one talks about, which is you need to acquire a good set of trading skills, because this is what's going to help you become profitable in the Forex market. And I believe you don't want to get involved with the Forex market and lose money all day. So this is basically it about the Forex market and who's involved or what's involved in the Forex market. Up next, we're going to be talking about how money is actually made in the Forex market. And trust me, you're going to love it. In this lesson, I want to elaborate more on how profit is being made in the Forex market as a retail Forex trader. So there are three components needed to successfully trade the Forex market or make profit from the Forex market. The first being a currency pair. This simply means two currencies paired together. So it could be the euro and the US dollar. It could be the Japanese yen and the Great British pounds. Just two currencies paired together is called a currency pair. So this is what you'll be trading in the Forex market. Then you need an exchange rate. So an exchange rate is simply the quantity of a particular currency needed to purchase another currency. So you're going to see more of this as we move forward with this lesson. Then you need a trading capital. So a trading capital is simply the amount of money needed to trade the Forex market. So moving on, in this lesson, we're going to be making use of these criteria. So we're going to be making use of the Euro USD as a currency pair, and we're going to be making use of an exchange rate of 2.0. I'm going to explain what that means, and a trading capital of $1,000. So the exchange rate of 2.0 in this lesson means you need $2 to purchase 1 euro. So as we have said, an exchange rate is simply the amount of a particular currency needed to purchase another currency. So in this case, 2.0 means we need 2 US dollar to purchase 1 euro, or we need 1 euro to purchase 2 US dollar. So assuming this exchange rate here was let's say 5.00, so it means we needed 5 US dollar to purchase 1 euro, or 1 euro to purchase 5 US dollar. So that's basically it, and these are the tools or the criteria we'll be using to explain how profit is being made in the forex market as a retail forex trader. So something to also note is that profit is being made simply based on making predictions on the exchange rate between two different currencies. So in this case, let's say for example, Euro USD. So in order to successfully make profit trading the forex market, all you have to do is say, I believe the exchange rate between Euro and US dollar is going to rise, or the exchange rate between Euro and US dollar is going to fall. So this is where the concept of buying and selling comes in. So when you see traders say, I'm going to buy Euro USD, what they mean is I'm predicting that the exchange rate between Euro and US dollar is going to rise. Or when they say I'm going to sell Euro USD, it means they are predicting that the exchange rate between Euro and US dollar is going to fall. So we're going to take a look at a few examples on what I mean by buying and selling. So taking a buy trade or taking a sell trade. Now we're going to be starting with a buy trade. Now in this example, we're going to be using the same exchange rate of 2.00, and the trade prediction here is buy, meaning we're going to be predicting that the exchange rate between Euro and US dollar is going to rise, and our stake is $1,000. So stake is our trading capital. So we're going to be trading with $1,000. Now, assuming after placing the trade, or after making your prediction saying the exchange rate between Euro and US dollar is going to rise, so you made this prediction when the exchange rate was at 2.0. So if the exchange rate rises to 2.1, for example, it means the exchange rate made a 0.1 movement. So it made a 0.1 increase. Now what you simply do is multiply your trading capital by that movement and you get a profit. So in this case, if the exchange rate rises by 0.1, then the new exchange rate becomes 2.1, because it's just a 0.1 increase in the exchange rate. So it's going to be 0.1 times $1,000, which gives you $100. So that's your profit. It's as simple as that. So let's say, for example, the exchange rate between Euro and US dollar rises from 2.0 to 10.0. So it means the exchange rate rose by 8.0. I don't know if you understand or you're following me. So it means the exchange rate rises by 8.0. So you're going to multiply 8 by $1,000, which is $8,000. So that's your profit. So another quick example. If the exchange rate rises by 0.5, so it means the new exchange rate would be 2.5, because the exchange rate has risen from 2.0 to 2.5, which means there's a 0.5 increase in the exchange rate. So you're going to multiply the 0.5 by your $1,000, which will give you $500. So that's basically your profit. So we're going to make use of another example using a sell trade. So this time we're going to be predicting that the exchange rate is going to decline in value. So the first example we had was taking a buy trade, which means predicting that the exchange rate between Euro and US dollar is going to rise. So now we are predicting that the exchange rate between Euro and US dollar is going to fall. So this is where the sell trade idea comes in. So we're going to be using the same exchange rate of 2.0, and trade prediction is a sell trade because we are predicting for a decrease in the exchange rate between Euro and US dollar. And we're going to use the same stake, which is our capital of $1,000. So now, if the exchange rate decreases by 0.2, it means 2.0 minus 0.2, which is the decrease in the exchange rate. So the new exchange rate becomes 1.8. So you're going to multiply the 0.2 by your $1,000, which gives you $200, and that's going to be your profit. Why? Because we are predicting that the exchange rate is going to decline in value. And now, successfully, the exchange rate has actually declined from 2.0 to 1.8, which gives us a 0.2 decrease in the exchange rate. So whatever value the exchange rate decreases by is what we're going to multiply by our $1,000 capital, $1,000 trading amount, for us to get our profit. So let's say, for example, the exchange rate decreases by 0.5. So the new exchange rate would have been 1.5 instead of 2.0, because a 0.5 decrease from 2.0 gives us 1.5. So the 0.5 will be multiplied by our stake, which is $1,000, and then we get $500. So that's going to be our profit. So there's something also very important to understand about how profit is being made. So the same way you make profits when you predict the exchange rate is going to rise or the exchange rate is going to fall, and it actually happens like that and you make profits, you can also lose money in that same manner. What I mean is, let's say for example, you make a prediction and says the exchange rate between euro and US dollar is going to rise in value, and it actually goes in the opposite direction, then you're going to lose money. So I'm just going to go to the next slide so we can understand this clearly. Now, in this case, we're going to be making use of a buy trade. So right now I'm explaining how you actually lose money as a retail forex trader. So same exchange rate of 2.0. So it means we need $2 to get 1 euro, or we need 1 euro to get $2. Okay. Now our prediction is a buy trade, which means there's going to be an increase in the exchange rate between euro and US dollar. And now our stake is $1,000, which means we are trading with a capital of $1,000. So imagine expecting the price to rise from 2.0 to 2.5, so you can actually make profits, or rise from 2.0 to 3.0, then the price falls down to, let's say, 1.8. So now you made a prediction at 2.0 that it's going to go up. So it's kind of like you've made a deal saying if it goes up, you're going to pay me so amount of money. But unfortunately, the price goes in the opposite direction. So you are going to lose 0.2 times $1,000, which is $200. You get the logic now. So if the price goes against your prediction, you are going to lose money. So that's the idea with how profit is being made trading the forex market as a retail forex trader. So the same way you make profit, you can also lose money the exact same way if the price or the exchange rate goes in the opposite direction of your prediction. So that's basically it about how profit is being made as a retail forex trader. So let's take a look at a quick few summary before I leave you guys. So you must understand that making profit involves one currency pair, which is, it could be euro and US dollar, it could be GBP, JPY, and Japanese yen. So it must involve a currency pair, so two different currencies together. Then it must also involve an exchange rate, because it is the fluctuation in the value of the exchange rate that actually makes you money, nothing else. Then you must have a trading capital. So that these are the three important elements in order to successfully trade the forex market and actually make profits. Now, for retail forex traders, profits is simply made by making predictions based on the exchange rate between two different currencies. So let's say, for example, you have an exchange rate. You can make profit simply by predicting that exchange rate is going to increase in value or decrease in value. And you only make profit if it actually goes in favor of your prediction. So if the exchange rate goes against your prediction, you're going to lose money. And something very important to notice, as a retail forex trader, you do not need to physically own the US dollar or physically exchange your dollar to euro or physically own any currency at all. It's all done on the trading platform. All you have to do is put in your prediction and it's all done. So that's it for how profit is being made as a retail forex trader. I hope this is clear enough. Next, we'll be talking about a few tips on what to expect as a forex trader, or should I say being a forex trading millionaire. Yeah, that's it. See you in the next lesson.
Being able to trade for profit is one of the many benefits of acquiring a forex trading skill. But there's more. You wouldn't have to work difficult 9-to-5 jobs when you make consistent profit from trading. You can become your own boss, take back control of your time, and earn enough money to make great investments that could eventually lead to financial freedom. It seems learning to trade Forex is the real deal. Don't worry, BraveFX Academy got you covered. Trading for profit is the main reason people learn to trade Forex. But let's take a look at some of the pros and cons. For pros, you're the boss and can trade whenever you like, and in the process make money even while you sleep, and this can lead to financial freedom. As for cons, you have to take a financial risk and you're not in total control, because markets can be unpredictable. Besides trading for profit, you could run a consulting firm. The trading industry is filled with people seeking professional expertise. This is where you come in. For pros, you can build a company around the idea and charge whatever fees you want for solving people's problems to earn extra income. As for cons, it requires capital to set up a website. Ads would also have to be carried out to reach your audience, and it requires your time. You can also become a professional technical analyst at a trading firm working as a market analyst or a trading manager for their clients. For pros, you get an actual job with guaranteed income while you improve your trading skills in the process, and you also get to connect with high net worth individuals. As for cons, getting this kind of job is not guaranteed. It requires commitment, and there's little or no flexibility on how you spend your time. So, one of the best ways to take advantage of your trading skills is teaching others how to trade Forex and getting paid for your knowledge and experience. With this idea, you can launch your own online trading academy like BraveFX. For pros, you can build a business around this idea and charge whatever you feel comfortable with. You would also become a mentor to your students, generate steady cash flow, and create financial opportunities for others. As for cons, it requires capital and hard work to reach your audience. So the big question is, why only trade for profit when you can also run a business with your trading skill?
So many individuals are getting to the Forex market because they believe Forex trading is going to make them rich. Now that's true, but the thing is, Forex trading requires patience, it requires discipline and effort in order to become a successful Forex trader. The reason why I'm saying this is because Forex trading is not a get-rich-quick scheme, and over 90% of all traders lose money. Now, I don't believe people are losing money because they lack the trading discipline or the skills needed to successfully trade the Forex market. So from my experience, there are 4 different skills needed to become a successful Forex trader. Now, the first being, having a good trading strategy. Now, that's easy to attain because we're going to teach you all that about trading strategy, the technicalities behind Forex trading and all that. But the most important fact is that you need to understand risk management. Risk management is what's going to help you become sustainable, okay, in the Forex market. Why? Because without risk management, you could actually make $1 million today and lose $5 million tomorrow. You could make $1,000 today and lose $3,000 tomorrow. So what's the point? So at the end of the day, it's not going to matter if you made $1,000 tomorrow if you can't keep what you've made. So this is where money management comes in. Then we have the trading psychology. Every trader needs to understand what trading psychology means. This has to do with discipline. It has to do with patience. It has to do with greed. So what's the point in taking a trade and making profits, but you are being too greedy to actually close the trade and book your profits, and maybe end up closing the trade in a loss? So risk management, trading psychology, a good trading strategy are what shapes up, a successful Forex trader. And I would also like to add a trading plan. A trading plan gives a trader an insight on when to actually trade, when not to trade, when to exit the market, and all that. So you can see that it does not depend only on having a solid trading strategy for you to become a successful trader. Now that's why statistics shows that over 90% of traders lose money, because when a trader or a newbie acquires a set of trading skills, they feel, oh, I'm there, I'm the boss, I can make this happen, you get. And most of this is also attributed to what people see on the internet. Most of this internet stunts are scams, okay? So you should learn to set realistic goals and not just base your trading career on hopes and thoughts that would probably never happen. Now, if you become a successful trader in just a month or a year, most of that trading success is going to be based on luck, and you don't want that because luck isn't sustainable, okay? So it's best to grow organically and make profit progressively. Now, using myself as a case study, I started trading in 2015, but I wasn't making consistent profit in 2015. I actually started making profit in 2019, but I didn't give up, okay? I lost a lot of money and I blew so many accounts, but all this made up the experience I have today, in which I'm able to, pass the same knowledge to you to help you become, profitable traders. Now, even when I started making profit in 2019, I didn't, start making millions of dollars or hundreds of thousands of dollars. I made just enough to, take care of myself and my family. And I also made enough profits to be able to invest in the things I love. So this investment includes Bitcoin and, real estate. And this made me a lot of money that I don't even have to risk so much money in Forex anymore. So that's it, guys. Forex is a gradual grind, okay? It's not a get-rich-quick scheme. It takes effort, it takes discipline, it takes patience for you to actually become a successful Forex trader that'll be sustainable in the long run. So that's it for this lesson. I just wanted to, let you know how important it is to know how to set realistic goals when it comes to Forex trading, instead of getting your hopes high in, dreams and goals or Lamborghinis that will actually or probably not happen. So in the next lesson, we're going to be having a brief summary on everything we've learned in what is Forex and an introduction to Forex trading. So here's a brief summary on everything we've learned so far on introduction to Forex. So in this course, we talked about what Forex is, which is foreign exchange, and it involves the exchange of one currency to another. We also talked about the Forex market and what it's made up of. So we know the Forex market is made up of the government, central banks, large financial institutions, and also retail traders. We also talked about how profit is being made in the Forex market, and went as far as talking about how we should approach the Forex market. Okay, so the Forex market is not a get-rich-quick scheme. You take it slowly, learn everything we have to teach in our academy, practice, and ask questions. So that's actually the best way to learn and get maximum results from this academy. So we also talked about a few reasons why you need to learn Forex trading. Okay, so you can go ahead and watch these videos all over again to get a good grasp at this course. So this is an introduction to Forex. It's just the basics, and we thought it's best to start with this, so we'll brush you up on what Forex is all about. And now lastly, the calculations carried out in this course are not meant to be memorized. So most of these calculations are automatically done by your trading firms. I'm talking about the calculations we had when we're talking about how profit is being made in the Forex market. So you don't need to memorize those calculations. So we only did that for you to understand how profit is being made. So that's it for this course. If you have questions, make sure you use the question section at the end of this course, and also take the quiz. Okay, read the questions carefully because they can be challenging sometimes. So just read the question carefully, answer the quizzes, and ask questions if you've got any, and we'll respond to you as swiftly as we can. In this section, we're going to discuss about currency pairs and trading sessions. Okay, so I'm going to teach you what currency pairs is all about, the types of currency pairs, and the best type of currency pairs to trade as a beginner trader. Okay, and we're also going to take a look at the different trading time and sessions. So we're going to learn the best time to trade as a Forex trader. Okay, as a beginner trader, what's the best time to trade, the different times in which the Forex market is open globally, and how to take advantage of these different time and sessions. So that's briefly what this section is going to be all about. So after talking about what the Forex market is all about and what the Forex market is made up of, now it's time to take a look at what we trade in the Forex market, which is actually currency pairs. So this section is dedicated to help you understand everything about currency pairs and everything about Forex trading time and sessions. In this lesson, we're going to be talking about currency pairs. Now, the term currency pair is one of the most popular trading terms you're going to come across as a Forex trader. A currency pair simply means two currencies paired together by an exchange rate. Now, a currency pair is made up of a base currency and a quote currency. Okay, so let's say, for example, we're having the euro and the US dollar. So this means the euro is the base currency and the US dollar is the quote currency. So the base currency is simply the first currency that appears in a currency pair, while the quote currency is the second currency that appears in a currency pair. So here's another example. Let's say we have the USD JPY. So the US dollar and the Japanese yen is a currency pair. So in this case, the US dollar appears first, so it's referred to as the base currency, while the Japanese yen is referred to as the quote currency because it appears last. So it's the second currency in a currency pair. So another important fact about the currency pair is the exchange rate. So from our earlier course, Introduction to Forex, we said an exchange rate simply means the quantity of a particular currency needed to purchase another currency. So these weird things get even more interesting. So for a currency pair, an exchange rate between a currency pair is the quantity of the quote currency needed to purchase the base currency. So I'm going to repeat once more. So an exchange rate between a currency pair is the quantity or the amount of a quote currency needed to purchase the base currency. So back to our example, let's say Euro USD, for example. Let's say Euro USD, a currency pair, has an exchange rate of, let's say, 1.254. So this means you need 1.254 US dollar to purchase 1 euro. Okay? So another example, let's say we have a currency pair USD JPY. So in this case, US dollar is the base currency, while Japanese yen, JPY, is the quote currency. So if they were to have an exchange rate of, let's say, 5.648, so this means you need 5.648 of the Japanese yen, which is the quote currency, to purchase one US dollar, which is the base currency. So this is basically the important things you need to know about currency pairs and how it works with the exchange rate. So if this is still not clear enough, you are going to learn more on the next lesson, which we explained and elaborated more on currency pairs using an animated video with graphics. So I hope that makes this explanation clearer. Okay, see you in the next lesson.
A currency pair is a combination of two different currencies. For example, Euro and US dollar combined gives Euro USD. Currency pairs are made up of a base currency, which is the first currency, and a quote currency, which is the second currency. Every currency pair comes with a price tag known as the exchange rate. Therefore, if there's a price tag of 2.000 on the currency pair USD CAD, it means 2.000 is its exchange rate. This also means you need to exchange to Canadian dollars, which is the quote currency, for $1 US, which is the base currency. There are over 100 currency pairs available to traders, but this doesn't mean we have to trade everything. Imagine having to choose between trading the currency pair of either Zimbabwe and Iran or the United States and Europe. My guess is you would choose to trade the currencies of countries with great economies rather than countries with weak economies. The main reason is because more money flows through great economies, and currencies with larger financial inflows and outflows provide the best trade opportunities. Generally, there are three categories of currency pairs. Understanding these categories would help you decide the best currency pairs to trade. The first and most important currency pairs in the Forex market are the 7 major currency pairs. This is because they hold the highest daily trading volume, and most of the global Forex trading activities happens within these pairs. They are made up of a combination of the US dollar and the currencies of major economies around the world. The minor currency pairs are made up of a combination of currencies with great economies but do not contain the US dollar. They do not get as much trading volume as the major pairs, but also create great trade opportunities. The exotic currency pairs are made up of a combination of the US dollar and the currency of a country with an emerging economy. Exotic pairs are not widely traded because there are fewer trade activities around these pairs. In conclusion, the major currency pairs are the best because they present better trade opportunities.
The Forex market is open to retail Forex traders 5 times a week. That's from Mondays to Fridays. And a typical trading day is subdivided into 4 different sections. So we have the London section, the New York session, the Asian session, and the Sydney session. So in the next lesson, we're going to take a look at individual trading sections, the advantages and the disadvantages, and how they affect us as retail Forex traders.
A typical trading day in the Forex market is divided into trading sessions, and these sessions show us the most active trading hours of the day. The higher the liquidity and trade activities in the market, the better trade opportunities you get. There are generally 4 trading sessions in a day. We have the New York sessions, also known as the North America session, the London session, also called the European session, the Tokyo session, also called the Asian session, and lastly, the Sydney session, also called the Australia session. New York City is the financial hub of the United States. This is where Wall Street and major financial institutions are located. The New York session is when financial institutions in the United States are open for business, and traders are ready to dive into the action of the Forex market. The trading activities in New York start at 8 a.m. local time and 1 p.m. in GMT, while it closes at 5 p.m. local time and 10 p.m. in GMT. The United Kingdom is the center of attention for the European markets, and London is the capital. Most of the trade activities in Europe takes place in London, so this makes the London session the most active trading session. The trading activities in London starts at 8 a.m. local time and 8 a.m. in GMT, while it closes at 5 p.m. local time and 5 p.m. in GMT. Japan is one of the most prominent countries in Asia, and the capital Tokyo is the powerhouse of the Asian Forex market. That's why the Tokyo session is also referred to as the Asian session. Trading activities in Tokyo starts at 9 a.m. local time and 12 a.m. in GMT, while it closes at 6 p.m. local time and 9 a.m. in GMT. Sydney is the capital of Australia, and this is the trading session with the least trade activity compared to other sessions. Trading activities in Sydney starts at 8 a.m. local time and 9 p.m. in GMT, while it closes at 4 p.m. local time and 5 a.m. in GMT. The Forex market can be boring sometimes when prices are barely moving. This isn't the best time to trade. So, what is the best time of the day to trade? This is when the London session overlaps with the New York session. This is a clash between the two largest Forex trading hotspots in the world. There are lots of trade activities and great trade opportunities during this time between 12 p.m. and 5 p.m. GMT. As you get more trading experience, your best trading time would depend on your trading techniques rather than a specific timeline.
So we talked about currency pairs. So a currency pair is simply two different currency paired together by an exchange rate. So an exchange rate is the quantity of the quote currency needed to purchase the base currency. So we talked about the different type of currency pairs, which are the major currency pairs, the minor and the exotic pairs. And we also talked about the different Forex trading time and sections. So we have the London section, the New York section, the Sydney section, and the Asian section. So this is basically it about this course. So this is important because these are some really important key elements for every Forex trader to know, okay? Because they're going to play a major role in your career as a Forex trader. So that's it. In the next course, we'll be talking about Forex brokers. So these are actually the firms that enable you, trade the Forex market. They connect you to the Forex market. So that's it. Please, if you have questions, use the question section at the end of this course and make sure you take the quizzes, okay? Take your time to read the questions, answer the quizzes, and if you have questions, use the question section at the end of this course. Just a quick pause before we get back to the lesson. I want to briefly show you what the full academy looks like because it's a lot more than what you're watching right now on YouTube. So this is your dashboard, super clean, shows all your learning progress and everything is tracked automatically. When you click on this button over here, it takes you to the course. Interface looks clean with no distractions, and on the right hand side you have access to all the lessons, beginners, intermediate and advanced class with over 220 videos and 25 hours worth of training step by step. Now the free YouTube course you're watching, that's only the beginners basics, right? Understanding Forex, account setup and TradingView platform navigation. All this gets you ready to trade. My academy is where I teach the complete trading system that helps you become a professional trader. So the actual trading strategies, price action, chart patterns, market analysis, risk management, and trade management. That's what all these 220 video lessons cover. Over here, you get access to the resource tab where you can find free downloadable PDF lessons for each section. This course is equipped with quizzes to test your knowledge on every lesson being taught. Unfortunately, you can't take these quizzes on YouTube. They're only available to my students through your personalized dashboard. And yes, something really useful. When you go to the progress section, you can review your quiz results, see what you're doing wrong, and learn from your mistakes. You can also contact me directly if you need help with any lesson. All you have to do is go to the support section and use this form over here. This platform is also accessible on mobile devices, so you can learn on the go, wherever you are, any time of the day, right? So that's the full academy and what your experience looks like when you become a student. Over 220 video lessons teaching you everything to go from being a complete beginner to an advanced professional trader. I already have over 6,000 students learning from me at the moment. Join them today by clicking the link in the description box. If you're serious about becoming a professional trader, this is all you need. All right, let's get back to the lesson. Now we're going to talk about Forex brokers. So in this section, I'm going to be teaching you everything you need to know about Forex brokers, the different types of Forex brokers, and we're also going to take a look at a brief history of the Forex market and retail Forex brokers. Okay, so I'm going to also explain leverage. This is very important to understand as a trader because this is the basis in which massive profit is being made in the Forex market as well as losses. Okay, so it's proper to understand leverage, and in this section I'm going to try as much as possible to help you understand what leverage is all about. And we're also going to talk about the criteria for choosing the right broker, and lastly we're going to talk about an introduction to a demo trading account. Okay, so a demo trading account is kind of like a sandbox where you get to carry out, dummy trades without real money. So that's just a brief overview of this section. So I'm going to repeat once more. We're going to talk about forex brokers, a brief history of forex brokers. We're going to take a look at leverage. We're going to talk about the different types of forex brokers, and we're also going to talk about how forex brokers make money. Then we are going to move on to the criteria for choosing the right forex brokers for you. So this section is important because without forex brokers you are definitely not going to be trading. Okay, so it's important to understand what forex brokers are and how to choose the right forex broker. Okay, so that's what this section is going to be all about. Forex brokers are financial institutions that connect retail forex traders to the forex market. So they act as a middleman between the forex traders and the larger financial market or the larger forex market, which might include banks or other large financial institutions. So when you carry out your trades in a forex broker, they are responsible for purchasing the underlying currencies if they have to be purchased. So they facilitate the purchase of currencies on your behalf from either the banks or other financial institutions. They also make it possible for you to make withdrawals and deposits into the forex market. So something very interesting about the forex brokers is that without the forex brokers, it wouldn't have been possible to become a retail forex trader today. The reason is because they provide us with leverage to take advantage of the forex market. So as we move on with this course, we're going to learn more about leverage and how it affects us as a retail forex trader. Leverage is a tool provided by forex brokers to enable you control a large sum of capital with just a small trading deposit. This is one of the reasons why forex trading is enticing to so many traders around the world. Because ideally, in order for you to make significant profit trading the forex market, you need to control a huge sum of capital. So imagine having to trade with $100,000 just to make $1,000 profit. That's kind of not sustainable for all forex traders. So this is the reason why leverage is so important. Now this is how it works. Let's say, for example, you deposit $1,000 in your trading firm. So what the broker does is they borrow you a huge sum of capital corresponding to your trading deposit depending on leverage chosen in order for you to take advantage of the forex market. So when you sign up for a trading platform, you're going to get options on leverage such as 1:500, 1:200, or 1:1000. What this means is if you choose a leverage of 1:500, if you're making a $1,000 deposit, you will be able to trade currencies worth up to 500,000 units. Okay, so it's going to be basically your trade deposit multiplied by the leverage you are using. So let's say, for example, you are depositing $1,000 and you are using a leverage of 1:1000. It means you'll be able to trade currencies worth 1 million units, or let's say $1 million. But I won't call it dollars because they are measured in units, but it's kind of like the same preference. So now, leverage is a two-edged sword. Now, I know you might think, okay, because now you have the opportunity to trade, large sum of capital, you could just, jump to the forex market and start putting in trades. Yes, if your trade goes right, you're going to make significant profits, life-changing gains. But it goes both ways. If your trade goes wrong, you're also going to lose significantly. That's how leverage works. So just because you're given the tool and the opportunity to trade large sum of capital doesn't mean you can just go ahead and jump to the forex market and start putting in trade. You need to actually know what you're doing for you to fully utilize, the tool leverage. Now, in the next course, we're going to be talking more on how to create a trading account, how to sign up, and how to choose the right leverage. So for now, just know that leverage is a tool that enables you to control a large sum of capital with just a small trading deposit. So in the next lesson, we're going to be talking about the different types of forex brokers. In this lesson, we'll be talking about the types of forex brokers. So this is very important because understanding the types of forex brokers and how these brokers work will help you decide the best broker for you. Okay, so when it comes to choosing the right broker where you're going to carry out all your trades, understanding the different types of forex brokers and how they operate would give you an insight on what to expect from these brokers and help you make the better decision on what kind of broker you would like to trade with. So there are basically two different types of brokers. Okay, so we have the dealing desk brokers and we have the non-dealing desk broker. So I'm just going to go over this very quick. So I've highlighted a few points. So I'm going to be explaining these two different types of brokers, and at the bottom of this lesson or this section, you're going to get the PDF file I'm using to make this explanation, so to teach you the two different types of brokers. So don't worry about the write-ups right now. Just listen, pay attention to the things I'm going to be talking about. You are going to get this file later on. So basically, two different types of brokers. So we have the dealing desk brokers and the non-dealing desk brokers. So I'll be starting with the dealing desk brokers. So the dealing desk brokers are also known as the market makers. The reason is because whenever a trader carries out a trade, the broker is responsible for taking the other side of that trade. So basically, this is how brokers work. So whenever a trader places a buy trade or a sell trade, that trade needs to be paired with another trade. Okay, so let's say, for example, you're opening a buy trade, so there have to be a trader who wants to open a sell trade on whatever asset you are trading. So let's say, for example, you're going to trade gold and you're going to take a buy trade with one lot on gold. This means the broker has to pair your trade with someone who wants to take a sell trade with one lot on gold. So if you make profits, the trader on the other end of your trade pays you the profit, okay? But if you lose, then your money is being paid to the other trader, okay? That's basically how brokers operate and how trading works in its most basic form. So for dealing desk brokers, what they do is they create the market. So what this means is that whenever you open a buy trade, the broker is responsible for taking the sell trade, so the opposite side of your trade. So this is to make sure you make money whenever your trade goes right. So if you take a sell trade, the broker is responsible for opening a buy trade to counter your trade. So if you make profits, the broker pays you, where if you lose money, you pay the broker. So that's basically what dealing desk brokers are all about. So real quick, we're going to take a look at some pros and cons of this type of brokers. Okay, so there's a lot to know about these types of brokers, and I'm going to shed more light as we come close to the end of this lesson. So for a few pros, so since the broker are responsible for creating the market where you trade, so which means they take the opposite side of your trade, this makes the broker fast. Okay, so whenever you click a buy trade, it executes almost instantly, okay, just within a few milliseconds. So trade executions are usually fast with these brokers because everything is done in-house. Okay, so because these types of brokers take the other side of your trade, this means they make profits while you lose, or when you lose, excuse me. So when you lose a trade, it means the broker makes profits because they are taking the opposite side of your trade. So this makes them provide low commissions and trading fees. So if you use a dealing desk brokers, you are definitely going to get much cheaper commissions and much cheaper trading fees when you trade with this type of brokers. And they also offer tight spreads. So don't worry, in the next lesson when we talk about how brokers make money, we're going to explain what spreads means. Okay, so just a brief overview. Spread is simply the way, one of the various ways in which forex brokers make profits. So these are just the few pros. So they are fast. These brokers are fast. They offer low commissions and trading fees, and they offer tight spreads. So these are the pros or the advantages of using a dealing desk broker. So for cons, so the disadvantage is that when the broker, when the trader loses money, when a trader makes profits, the broker loses money. Okay, so this means you are likely going to lose more trades because there's going to be a conflict of interest between the broker and the traders, because the broker knows if you lose a trade, it means more money for them. So there's a good chance that, or there's a likelihood that the broker will do everything possible to make sure the trade goes against you, either by giving you slow execution, or by just putting some stuff on the charts, or just doing some market manipulation that will make you lose more trades rather than win more, because they know if you lose trades, then they make money. So this is the major disadvantage of a dealing desk broker. So they make money when you lose money. So this means it's risky for their business model. Okay, so it's easy for them to play with traders' funds, because they know, okay, they are taking the other sides of your trade, so it's risky. So that's just the major disadvantage of using a dealing desk broker. So now we're going to talk about the non-dealing desk broker. So these are referred to as the safest type of forex brokers, okay, because they use a process known as STP. Okay, so this is known as straight through processing. What this means is that whenever you take a trade, these brokers transfer your trade directly to large financial institutions or banks. Okay, so it could be commercial banks, it could be the central banks. So they make sure you always have someone on the other end of your trade, and these are usually large financial institutions and banks. So they have no conflict of interest. Okay, so they don't take the other side of your trades because they are aware of the risk involved in doing that. So whenever you take a trade on a non-dealing desk brokers, your trade is automatically transferred to the large financial institutions or banks for them to carry the other side of your trade. So whenever you make profit, the banks or the financial institutions are responsible for paying you the profit made. And if you lose money, those money you lost goes straight to the financial institutions or banks. And the non-dealing desk broker also use a technology known as the ECN, which is the Electronic Communication Network. So the ECN is a network of traders, okay, globally, all over the world, and different brokers connect and link up liquidity with each other, okay, using this technology. So this means whenever you open a trade, so these brokers find other traders that are likely going to take the opposite side of your trades and pair you with them. Okay, so most times they do this first. So if there's no trader to take the other side of your trade, then they use the STP process by sending your trades directly to the bank. So this is basically what the non-dealing desk broker does. Okay, they use a combination of both the ECN and XTP to provide a marketplace for you where you get to carry out your trade activities. Okay, so the key point here is that they do not take the other side of your trade, so there's no conflict of interest. Rather, they even want you to make more profit, because the more trades you make, the more profits they take or they get from commissions and spreads and so on. So we're going to take a look at a few pros. So the thing is, for advantages, a non-dealing desk brokers gives you more transparent price, because these prices are taken directly from the markets, from large financial institutions and so on. So like I said earlier, another advantage is that there is no conflict of interest. So the broker has your best interest at heart, because they know the longer they can keep you trading, then the more profits they are likely going to make. Okay, and lastly, they provide you with the best service to make sure they help you get the best trade result possible. So like I said, so relating to the previous point, it all helps you get better at trading, keeps you longer in the game, because the longer you spend in the game, the more profit they make from spreads and commissions. So for a few cons, they have a higher commission. Okay, they charge higher commissions, higher fees compared to the non-dealing desk brokers, because the only way they make profit is through spreads and these commissions and fees, because they don't make profit when you lose trades. So this is the reason why they offer higher commission and higher spreads. And lastly, sometimes you may experience a lag in trade execution because the trades are not carried out in-house. So this is basically the two different types of brokers, so the dealing desk brokers and the non-dealing desk brokers. So I believe with this information you will be able to decide which broker suits your needs. Okay, so are you going to risk trading with a broker that makes profit when you lose just because you want tighter spread and lower commission, or are you going to trade with the brokers that have your best interest at heart, even if they charge a slightly higher fees? So that's it briefly for this lesson. In the next lesson, we'll be talking about how brokers make profits. In this lesson, we're going to talk about how brokers make money. Okay, so there are three different ways in which brokers make money. So these are the most common ways brokers make money. So we have through spreads, we have through commissions, and we have from the loss of other traders. So remember when we talked about the dealing desk brokers, so the market maker brokers, this is one of the most important ways in which they make profit. So they make profit when you lose trades. So that's if you are trading with a dealing desk broker. So I believe you already know all about that, since we discussed about that in the previous lesson. So as for commissions are simply fixed fees set on every trade you take, depending on the type of trading accounts you are trading with on your Forex broker. So commissions varies from broker to broker. So it's all about, the fees associated with every trade you take. So depending on your trade size, okay? But in this lesson, we would be focusing on spreads, because spread is one of the most important ways every broker make profit. So that's why I'll be spending more time talking about spreads in this lesson. So what are spreads? So spread is simply the difference between the buying price and the selling price of currencies offered by a forex broker. So let's say, for example, a forex broker is offering, the purchase of GBP USD. Okay, so a spread is simply the difference between the price at which that broker is willing to buy and the price at which the broker is willing to sell. So the idea here is that the brokers wants to buy cheaper from you and sell at an expensive price. So they buy cheap, they sell high. Okay, so they buy when it's cheap, or they buy at a cheaper price and they sell at an expensive price. So by default, they already make profit when transactions go on. So looking at the picture on the right hand side, this is not just associated with only forex brokers. So even your banks, so whenever you go to the bank to exchange currencies, I believe you can see something like this on the counter. So when they tell you we buy at and we sell at, so something like this, like in my country, Nigeria, we get this at the bank, and I believe every other bank get this as well. So if you've traveled by plane before, so at the airport you get exchange booths, and you always get this exchange rates at the counter when you want to exchange your currencies. So what this means is that the bank or the exchange booth, they are willing to buy at cheaper prices. Okay, so they tell you we are willing to buy at this particular price and we are willing to sell at this particular price. So if you are buying from them, they sell to you at a higher price. Okay, so if you are buying from them, they sell to you at a higher price, and if you are selling your currency to them in exchange for another currency, they buy from you at a higher price, at a lower price, excuse me. So they buy from you at a lower price and sell to you at a higher price. So by default, these exchange booths, your banks or the forex brokers, they make profits. Now, we're going to talk about three different terms. So we're going to talk about the quote, the bid, and the ask price. Okay, so a quote is simply the price stated on the exchange. Okay, the buying price and the selling price is known as a quote. So now I'm going to explain what bid and ask price means. So the official term for the buying price offered by the broker is known as the bid price. Okay, it's known as the bid, while the official term used to describe the selling price offered by the broker is known as the ask price. So this is just what bid and ask means. So I believe you must have heard about this on the internet or from articles and so on. So just know that the bid price simply means the price at which the broker is willing to buy, while the ask price is the price at which the broker is willing to sell. So spread, therefore, is the difference between the bid price and the ask price. So I'm just going to go back once more. So this price at that the bank or the broker or the exchange is willing to buy from you is known as the bid price, and the price at which the broker is willing to sell to you is known as the ask price. Okay, so there's a picture here to explain what this means. Okay, so this is, for example, Euro GBP, and this is the base currency, and this is the quote currency. Okay, so you can see this is the price offered by the broker at which they are willing to buy from you, and this is the price offered by the broker at which they are willing to sell to you. So as you can see, they are willing to sell to you at 1.1039, and they are willing to buy from you at 1.1037. So if you do the subtraction, so the difference between the ask price and the bid price is known as the spread. Okay, so if you do the calculation, you see there's a spread of 0.002. So this means, for example, you're going to place a trade of $10,000 on your forex broker, or you're going to carry an exchange of $10,000. You simply multiply your $10,000 by 0.002 and you get $2. So this means for every $10,000 worth of trades that is carried out with this quote, the broker or the exchange automatically makes $2 profit. Okay, irrespective of the fact that you might make profit or you might, make a loss. So by default, a fixed spread, okay, of 0.002 is placed on the quote. So remember, the quote is simply the price placed on the broker or the exchange rate at which they're willing to buy and sell. So this is basically known as a quote. So I'm just going to go up once more. So all these prices here are known as a quote. So this is a quote for South Africa rand. This is a quote for Canadian dollar. This is a quote for the British pounds. This is the quote for the Switzerland franc. So the bid price, the ask price in an exchange is known as a quote. Okay, while a bid, so a bid price is the price at which the broker or the exchange is willing to buy from you, while the ask price is the price at which the broker is willing to sell to you. Okay, so they are willing to sell at a much higher price and they are willing to buy from you at a cheaper price. So this makes it convenient for them to make profit whenever an exchange is carried out in their platform. So that's basically what spread is all about, and the difference between the ask price and the bid price is known as the spread, and this is how most forex brokers make profit. So I believe this lesson is clear enough. In the next lesson, we'll be talking about choosing the right broker. In this lesson, we'll be talking about the qualities of a good forex broker. The reason why we're doing this is because the forex market is filled with so many scam brokers. So you don't want to, get into a trading platform where you make deposits and you're not allowed to make withdrawals. So that's going to be very bad. So that's why we're talking about the 5 qualities of a great broker. So you know that, yes, these brokers are reliable and you can actually go ahead and trade with them. So the first on the list is every broker must be regulated. So what this means is whatever broker you choose to trade with, they must have acquired a license to operate legally in the jurisdiction in which they operate. So let's say, for example, you live in the United States and you're going to choose a broker in the United States. You have to make sure that these brokers have, acquired the license to operate in the United States. So they are not operating legally. So whenever, issues arise, they can be reported to the respective jurisdiction and they are going to face penalties for all that. But a broker that isn't regulated can go ahead and do whatever they like with their clients' money and all that, and can end up, scamming clients. So this is one way to ensure that, okay, this is a broker that's safe and you can actually rely on them. So secondly, a good forex broker must, have a great customer service. So the reason why this is important is because you might have issues with deposit, with withdrawals, or with your trading platform, with your entries, exits, spreads, and all that. So you should have a forex broker that has a customer service ready to respond to your queries 247 or at least 245. Okay, so Mondays to Fridays. So these are also another great qualities of a forex broker. So the third is a forex broker must have proven methods of deposits and withdrawals. So you don't want to get a forex broker where you put in money, you go through trading and then at the end of the day you're not able to make withdrawals. So you must make sure to have checked out that this forex broker offers various reliable methods of withdrawals and they actually work. So another way to do this is by checking out reviews from already existing users on the platform. So that's our fourth point. You must make sure there are reviews from existing users on the platform as proof that yes, their withdrawals work, their deposit works, and it's indeed a reliable forex broker. And lastly, a good forex broker must offer a demo account. So demo account is kind of like a sandbox where you practice without real money. So as we move on with this course, we're going to talk more on the demo account. Okay, so that's it for forex brokers and what you need to watch out for in order to trade with a great forex broker. And as for the regulations, we're going to link a PDF file at the bottom of this video, so you can just download it and check the various regulatory requirements for brokers in different jurisdictions. So if you're in the United States, you're going to see the various licenses every broker operating in the United States needs to have held in order for them to operate in the United States, or if you're in Europe or in Asia and stuff like that. So that's what the PDF is going to contain. So that's it about methods to choose a forex broker. So you should make sure whenever you're carrying out your research, a good forex broker has to check all these boxes in order for them to be considered reliable, or at least better than the others. So that's it about forex brokers. And lastly, I'm going to like to add one more point. So a forex broker should also offer competitive fees, so in terms of spread, commissions and all that, so you don't get ripped off from your trades. So that's it about forex brokers. Up next, we're going to be talking about demo trading. One of the most important features of forex brokers is that they provide traders with a demo trading account. Now, a demo trading account is simply a trading environment where traders get to practice and experience what actual forex trading feels like. So they get to carry out analysis, they get to carry out trades, buy, sell, they get to close trades, they get to do all the things you would expect to do in a real forex trading environment. But the difference is that in a demo account, you are provided with virtual funds. So yeah, you don't have to risk any of your trading capital. You don't have to risk any of your hard-earned money. So the forex broker basically gives you an account balance worth up to $100,000, $1 million, or even $1,000. So you get to experience what forex trading feels like. Yeah, you get to practice your trading skill, practice different trading tools. You get to build your trading confidence, just so you are prepared enough to face forex trading for real. So that's it about demo trading accounts and how new traders can take advantage of this feature for all forex brokers. So as we move forward with this academy, we're going to teach you how to create a trading account, how to create a demo trading account, and how to start demo trading before you actually go live by depositing real money to trade the forex market for you. So that's basically all you need to know about forex brokers. Here's a quick summary. A forex broker is simply a financial institution that connects retail forex traders to the forex market. So we talked about a brief history of forex brokers, and we also talked about leverage. So leverage is a tool provided by forex brokers to forex traders to enable them control large sum of capital with just a small trading deposit. So we talked about how forex brokers make profit with your trades. So this is where we talk about spreads, which is the difference between the bid and the ask price of a forex broker. So I believe you already know what that is, okay? And we talked about the different criteria to select a good broker or to pick a good broker when carrying out your research. So we said a good broker must be regulated. They must offer you a great customer service. They must also offer you, competitive trading fees and a demo account. One of the most important features to watch out for is proving deposits and withdrawal methods that can actually be validated by already existing users on the platform. So we talked about a demo account. So a demo account is simply a trading environment that lets you experience what real trading feels like without having to risk a real trading capital. So that's basically everything about forex brokers and the most important things I believe you need to know about forex brokers. So at the end of this lesson, there's going to be a quiz. Please make sure you answer these quizzes. And if you have questions, guys, use the question section at the end of this course. If any video or any content or any topic or lesson is not clear enough, please try as much as possible to rewatch the videos and then ask questions using the question section at the end of this lesson, and we'll respond to you as swiftly as we can. Now we're going to talk about setting up your forex trading account. So in this section, I'll be teaching you how to create a forex trading account and how to get your account verified with the required documents in order for you to get started with trading. So we're also going to talk about how to make deposits as well as the different methods for deposit, and I'm also going to show you how to make withdrawals, okay, as well as the different options available for withdrawals. So we're going to talk about the different trading account type offered by brokers and their requirements, their criteria, and their features. So lastly, I'm going to talk about recommended trading capital and the different trading terminal in which we would be using to carry out our trades. So in this lecture, we'll be talking about forex brokers and how to set up your trading account, okay? So on the screen here, this is FXTM, so it's Forex Time. This is one of my favorite brokers. I've been trading with them for quite some time. I think for about 4 years now. Yeah. So Forex Time allows clients to trade on a broker from Europe, from Africa, from some part of Asia. But if you are from North America, US, Canada, and so on, I don't think Forex Time accepts clients from those regions. So just do some research and look for trading platforms that allows clients to trade on their platform from these regions. So Basically, Forex Time is one of the most, recommended broker in my opinion. If you're in Europe, if you're in Africa, or some regions in Asia, they've got some ton of information there on their homepage. And I'm just going to use it as an example to explain how, setting up a trading account works. So if you're interested in using this platform, you can go ahead and, go through this course. So it's a step-by-step course on how to, set up your trading account, and I think it's going to be a very great help for you if you are going to use this trading platform as your preferred forex broker. So this is the home page. Basically nothing much to see here. They've got a few awards over the past 2 years, and there's a ton of information here if you want to learn about FX team. So this is the about section, so why, awards, and all that. So this is the market section. You get to check out all the various trading instruments they offer. So they offer forex. You can trade in indices, you can trade commodities, metals, even cryptocurrencies. So it's all there, and they've got some sort of educational platform for you to also learn stuff about Forex. So that's basically a quick summary about Forex Time, and we're going to dive into how to open an account right now. So this is basically how it works on almost all, Forex trading platforms or Forex brokers. So all you have to do is look for the open account button or a create account button, depending on the platform you are watching on, and then you click the open account button. So this page is just going to pop up, and on the registration page, so this is specifically for Forex Time. So I don't know how it's going to look on the Forex broker you're going to be using to trade, but on Forex Time, this is how it works. So you simply put in your first name, your last name, your country. I'm currently in Georgia, so that's why I'm having Georgia here, and your mobile number, email, and password. So that's basically all you need to sign up with a Forex broker. So when you click the register, so you confirm your email, confirm your phone number, and I think that's just it. Then all you have to do is go to the login section and log in your account. So in the next lesson, I'm going to show you how to set up your trading account. So after creating an account, it's not just about putting your email and password. There are also other criteria you need to meet up to in order for you to get started with trading. So I'm just going to log in here so we'll see how it looks from the inside. So yes, so this is my Forex Time account, my personal Forex Time account. So in the next lesson, we're going to be talking about the necessary documentations needed to be submitted in order for you to get access to the whole trading platform, in order for you to get started with trading. So this is basically the different trading options you have. So we'll take a look at this as we move down with the course. So for now, just know that this is how it works basically on almost all trading platforms. So you go to the website, you look for the create account or make an account, whatever button is there on their homepage. So you just create an account, put in your requested details, your email, phone number, country, first name and last name, and you sign up. So make sure you confirm your email and your phone number so you get access to the platform. So that's basically it for opening an account, and just a quick intro into setting up your trading account. So in the next lesson, we'll be talking about how to submit the necessary documents and how to successfully create your trading platform so you can start putting in some trades and probably start making some cool, nice moolah. So that's it for this lesson, guys. See you in the next lesson. So now we're going to talk about how to actually set up your trading account so you can start putting in trades, okay? So before you get access to a trading account and a set of trading tools to enable you trade, you need to submit a set of documents to verify your identity and your address. So this is actually the verification procedures that's required to give you access to the Forex market. So now we're just going to come over to this documentation section on Forex Time. So you click on the verify profile, and you're going to find two required documents. So this is your identity document and your proof of residence, okay? That's your POR. So for your identity documents, it could be a passport, it could be a driver's license or whatever ID. So I'm just going to click on upload so you see what it says. So you're going to scan the front and back of your ID and all that. So over here you can just select the country, and let's say for example you're in the UK, let's say United Kingdom. So it's going to show you the required documents to verify your identity if you're in the UK. So for UK citizens or UK residents, you need a driver license, and this is how it looks. then you can as well, use your passports to verify your identity. So that's that for, excuse me, identity verification. So you also need to verify your address, okay? So this could be a utility bill, a bank statement, or any official document that carries your name and your current residency address. So that's it for the required documents that's needed to get you access into the trading, the forex market. So that's it. So these are the documents required by FXTM, okay? Just these two documents. So other trading firms or trading brokers might require something different, but this is just basically the two most important documents required to get started with forex trading. So now that's out of the way, so when you get verified, all you have to do is come to my account and open an account. So this is where we're going to talk about the different type of trading accounts that the forex time broker offers to new traders or already experienced traders. So you have the micro account, you have the advantage account, and you have the advantage plus account. So micro account minimum deposit is $10. So this is basically for new traders who simply want to test the waters and get into trading with just a small balance and a few features. So this is what you can trade. You can trade forex, that's currencies. You can trade indices. You can trade metals, commodities. That's FX indices. Okay, you can trade stock baskets, but these are basically not really important. Okay, so what you should focus on right now is, as a new trader, is trading currencies and commodities. So that's it. So this is not bad. And you have the advantage account and you have the advantage plus. So the major difference is that you get more features in the advantage and advantage plus accounts. Okay, so you get to trade everything, so nothing is left out of the question as compared to having a micro account. But the only big difference is that you need to deposit a minimum of $200 in the advantage and the advantage plus account in order for you to actually get access to the forex market and start trading. So that's basically it. So all you have to do is click the button, open an account, and you get access to the account. Okay, they're going to give you a set of instructions you're going to follow, and that's going to get you set up for a trading account. So for the sake of this lesson, we're going to try out a demo account, okay, just to show you how the creation of an account looks like. So we're going to click on try the demo for the advantage plus account. Okay, so this is the screen, and this is what you get when you click on open a demo account. It's similar to what you get when you try to open a real account. So what you can see here is the currency. So you choose the currency of your trading account. You can choose Euro, USD, JBP, Naira. So I'm a Nigerian, so that's why I have the option for Naira here. Okay, so that's it. So after choosing your currency, then you go over to leverage. So we talked a little about leverage in our last course, in the previous course, okay? So just a quick rundown what leverage means. So according to what we have here on the platform, leverage is a loan that allows you to have more capital to trade with than what you initially deposited, okay? High leverage increases profits as well as risk. So this is what we talked about in our earlier courses and lectures. So we said leverage is just a tool provided by a forex broker to give traders an opportunity to control a large sum of capital with just a small deposit. So this is where you get to choose your leverage. So these are the options. You have 1:30, 1:1000, 1:300, 1:50, 1:2000, 100, 200, 25, 500, and 400. So I believe you already know what this means, but I'm just going to do a quick explanation. Okay, so we're going to be using a leverage of 1:500. So that's kind of like the average risk, okay, with your trades. So what this means is, if whatever balance you choose to start with is going to multiply by the leverage you have. So that's going to be the maximum amount of currency per unit you'll be able to trade in your forex account. So now I was choosing 1:500. Okay, now initial balance, you can start with a balance up to $1 million for a demo account. And remember, it's not refunds. Okay, these are just virtual currencies placed there for you to carry out trades and test your abilities with the forex market. So I'm just going to put this at $1,000. Okay, a more realistic balance, because I'm sure none of you is going to go ahead and deposit $1 million into your trading account. So $1,000 is realistic, and it's good. It's a good start for you to practice how trading feels like. Okay, so if we're having a $1,000 balance, for example, it's going to be multiplied by 500. So this means we are going to get 500,000 units worth of currencies to trade with. So it's just like saying, okay, instead of having $1,000, you're having $500,000 worth of currency to trade. Okay, but when it comes to trading or leverage, it does not carry the currency value like US dollar or euro. So it's measured in units. So we're going to talk more on that as we move forward with this course or the next course. Okay, so that's it. So all you have to do is select your currency, choose your leverage, then a password. So I'm just going to type in any password here. So yes, okay, it meets up to the requirement. So I'm just going to do this real quick. So that's it. So we have our currency, we have our leverage, we have a trading password, and I'm just going to click on open an account. Okay, so I'm doing this so we'll see how it really feels to create a trading account. But this is just a demo account, okay, for the purpose of this explanation. And this demo account is what we're going to be using throughout this lesson or throughout this academy to explain and teach you everything you need to know about trading. Okay, so now this is the pop-up we have on the screen is your new trading account is ready. So make a deposit or see my trading account. So of course it's a demo account, so we're not making any deposits. So just going to click on see my trading account. Okay, so this is an account overview. So this is where you get all the details of your trading account. Okay, so up here in this section you have your real accounts, and down below here you have your demo account. You see it says my demo account. So we have our Advantage Plus account, and this is our account number, our leverage, and current balance is $1,000. So that's it for opening an account. I'm just going to click that so we can see the details of our account. Okay, so here we have a demo account, trading server. So I'm going to explain what trading server means and what this number means. Okay, this is basically the details in which we are going to use to log in our trading terminal to start trading. But we're going to talk about this in the next lessons. Okay, so just to make this lesson short and not confuse you with so many details and information, so these are our login details. So we're going to see more of this in the next lesson. So that's basically how it works to excuse me, create a trading account, how to set up a trading account. But we use the demo account because it actually reflects what the creation of a trading account looks like. So just a quick rundown. First of all, before you get started with creating your trading account, you need to verify the necessary documentations needed by your trading platform. Okay, so a forex stamp is just your proof of identity and proof of address. Okay, so you can either use your driver's license or your passport to verify your address, or whatever document is required based on the country of your residence, or based on the country you have your citizenship with. Then you have your proof of residence, so which is your address, which could be a utility bill, a bank statement, or any document carrying your official name and your address. Then under my account section, account overview is where you get a summary of all your accounts. So up here, this is a summary of my real account, and down here, this summary of my demo account. And to create a new account, just click on the open new account, and you get the different options available for you in FXTM. So in the next lessons, we'll be talking about how to actually link up this your already open trading account with a trading terminal so you can start carrying out trades. In this lesson, we'll be talking about trading terminals. So a trading terminal is simply a software that lets you carry out trades. So the most popular trading terminal is known as the MetaTrader 4 or the MetaTrader 5, which is the MT4 or MT5 for short. So ideally, when you create an account with a brokerage firm, so let's say in this case FXTM, you get to choose between the MT4 and the MT5. So for FXTM, to be specific, when you create a micro account, you're only allowed to trade with the MT4 trading terminal or trading platform. And for the Advantage and Advantage Plus accounts, you can trade with either the MT4 or MT5. But the major difference between the MT4 and MT5 is just that the MT5 is an upgraded version of the MT4. So it provides traders with more trade tools, and it makes the trading experience swift. So that's basically the difference between the MT4 and the MT5. So on the FXTM platform, you get various options. Okay, so you get to choose between the mobile version, the desktop version, and for different applications like Android, iOS, Windows, and Mac. So in order to access these platforms, all you have to do is just come to this platform section, then click on download platforms. So on this page, you can see that you have all the different software here. So it's just for you to just download the one you want to use that's convenient for you, and log in with your details and get started with trading. So I'm going to talk about logging in a bit. So there's also the web version. Okay, so if you don't want to download the mobile version or the desktop version, you can also use the web version. So I'm just going to launch this so we can see how it looks. So this is basically how the web version looks. So all you have to do is log in with your MT4, MT5 details, your password, select your server, and yes, you are done. You are there with trading. So that's it about the web version, but I really don't recommend the web version because it's not as convenient as using the mobile versions. So talking about how to log in. So remember in our previous lesson, we created a demo account. So just going to our account overview. So below here, this is where we have our demo account. Okay. So when you click on this demo account, you can see a summary of your account details. So this is your trading server, this is your account number. Then the password you use in creating the account is what you're going to use to log in the trading platform. Okay. So in this case, we signed up an Advantage Plus account with the MT5. So here's our details. So when we download the MT5 on our mobile or our desktop, all you have to do is in the server section, search for the server, then use this account number and put in your password, and there you go. You have access to your trading account and you can start taking trades. So in the next course, we're going to talk more on MT5 for both mobile and desktop, and I'm going to show you how it works, how to properly log in, and how to take trades. Okay. So even with the trading environment, I'm going to explain all that for you. So in this course, this is basically what trading terminals are. Simply a platform where you carry out trades linked to your brokerage account. And on the trading terminal, all you can do there is open trades, close trades, and follow up your trade history, while deposits and withdrawals are carried out on your brokerage account. So in the next lesson, we're talking more about deposits and withdrawals. Now we're going to talk about withdrawals and deposits. So many forex brokers offer you numerous options to make withdrawals and deposits off your trading account. But since we're talking about FXTM platform, we're going to explore the various withdrawals and deposit options offered by this broker. Okay. Now, in order for us to access this section, all you have to do is click on My Money, and you get access to all the tools and sections that has to do with funding your account or making withdrawals from your account. So we're going to start with deposits. Now, on the deposit section, you can see the first options available are options available in my country. So as you can see, the currency here is Naira. So there's a Nigerian mobile banking, Nigerian instant card payments, Nigerian SMS banking, local card and QRO payments. So these are the various options available in my country. But to see other global options, you have the Visa. You can make deposit with the Visa card, MasterCard, Google Pay, credit card. So these are bank transfers. Okay, so these are banks available in my country. So you also have wallets like Scree, Perfect Money, and Neteller. So these are the various options available to make deposits into your trading account with the FXTM trading platform. Okay, so I know if you reside in other countries, you might get different options here depending on what's available in your country. So that's basically it for making deposits. So just to give you a quick look at how it works, let's assume you're going to make deposit with the Visa card. So all you have to do is click on the deposit button, and the page pops up. So what you do is you select the type of account you want to deposit. If it's if you have if you have more than one trading account, so you can select which account you would like to deposit to, or you can select a wallet. So ideally, when you create an account with FXM platform, you get access to the GBP wallet, USD wallet, Euro wallet, so you can choose whichever wallet you would like to make deposits into. Okay, so you select your currency. So let's say US dollar, for example. You can, let's say I'm going to deposit $1,000. Click confirm wallet. So let's say I'm going to choose the USD wallet, for example. $1,000, confirm, and I get the option to make the payment with my card. So my card is already linked to my account, so when I click on submit, I get the option to confirm my deposit and money is being forwarded into my trading account. So that's basically it for deposits. So I'm going to talk about withdrawals now. Okay, so this is the most important thing you want to watch out for when trading in a platform or with a forex broker, because it's quite easy to put funds in there, but withdrawing funds, it's actually the big deal. So again, Nigeria mobile banking. So this is one of the options available specifically for my country to make withdrawals from the FXTM broker. Now, other options include transfers to your debit or your credit card, bank wire. So I can actually transfer money from my Forex time broker to any international bank account in my name. Okay, so as far as I have a bank account in my name, I can make a wire transfer to those banks. I can also make local bank transfer to my local bank in Nigeria. So that's why I have these local payment methods here. So these are the cards available, both credit and debit cards withdrawal. Then you have the bank wire. I also have excuse me, the e-wallets withdrawal methods available. So that's basically it for making deposits and withdrawals. Okay, so on FXTM wallets, you can track all your balances. So if you made deposits into your local currency, your pounds, dollar, and euro, you get access to a breakdown of your total balance on your various wallets when you click on the My Wallet section. So internal transfers is just a section where you can make transfers within your account. So when you select this, you can make transfers from one wallet to another. So that's just what you do on the internal transfer section. So transferring of funds from one wallet to another. So let's say, for example, you are creating a new trading account and you want the balance to be the currency to be GBP or euro. You can simply transfer funds from your other accounts in US dollar to euro and fund your new trading account, which is in an alternate currency. So here you have your transaction history. Here you can track all your deposits, all your withdrawals and all that. So that's what you do in the transaction section. So you also have a conversion rate section. So here you get to see the actual rates at which the trading firm converts your currencies. Okay, so let's say, for example, I live in Nigeria and I'm making deposits with a dollar card. So yeah, I can get access to all the rates, the official rates on trading platform for deposits and withdrawals. So that's basically all you need to know about making deposits and withdrawals on the FXTM platform. And I think it's not far from this with other trading brokers. So it's similar to this, but maybe other trading firms might offer you more options, more withdrawal options, or more deposit options. Depends on your location and depending on the trading platform. Okay, so that's it for FXTM. I hope this helps. In the next lesson, we'll be talking about the recommended trading capital for Forex traders. So if you're a beginner trader, you want to watch out for the next lesson, okay? A recommended startup capital is one of the most important questions asked by new traders. Now, I highly recommend you start trading with a demo account for at least 2 weeks as a new trader. The reason is because this will enable you get to understand how Forex trading works, okay? You get to understand how price action works, how the chart works, how the Forex brokers work and all that. This is a stepping stone to getting the experience needed to actually trade a real account. Now, if you trade a demo account and you're able to acquire enough experience and confidence to actually trade a real account, don't jump into trading $1 million account or try to deposit $10,000 because you want to start making a lot of profits. That's not how trading works, okay? There's a big difference between trading a demo account and a real account, and the key difference here is emotions. When you trade a demo account, emotions are not involved. Why? Because subconsciously you're not trading with real funds or real capital. But on a real account, real funds are involved, so your emotions are involved, so you are prone to make mistakes. So when it's time to trade a real account, I recommend you trade with at least $10 for a start. Now, trading a real account with $10 doesn't mean you're going to be stuck with trading a $10 account forever, okay? This is just a stepping stone to understand how real Forex trading works, how the real trading works with your emotions involved, okay? Now, when you're able to trade for, let's say, a month, 2 months consistently without losing your $10, then you can gradually increase your trade deposits over time. So let's say in 2 months, you increase your $10 deposit to, let's say, $500 deposit. That's when you feel confident enough to handle such amount of money. So if you deposit a $10, for example, and it takes you 1 week and you lost the funds, deposit another $10. If you keep losing $10, do not deposit anything more than $10 until you are confident enough to be able to, make consistent profit with your $10. Okay, give yourself at least 2 months to practice trading a real account with as little as $10, because when you lose these funds, there's less or little or no emotional entanglement attached with that account, because okay, $10 is an amount you can afford to lose, compared to trying to start with $1,000 or $10,000 or $5,000. So this is my take on recommended startup capital. Okay, it all depends on your level of confidence, your level of experience. So as you climb the ladder of success gradually, you get to increase your trading balance. So let's say, for example, you start with $10, you try to trade for 2 months, and you're able to actually grow the account. You don't need to trade a $10 account and try to raise that $10 account to $1,000 or $10,000. It's all about consistency. If you're able to trade the $10 account for 2 months without actually ending that 2 months in a loss, then you can go ahead and increase your trading capital to $500 and try to see how far you can trade with that account. If in another 2 months you're able to trade the forex market, and even if you make $100 profit on your $500 or $200 profit at the end of 2 months, then you can confidently increase your balance. So gradually, like that, you get to a point where you can confidently trade up to $10,000 and just compound and grow your account balance over time. So as a new trader, I don't recommend jumping into the forex market with $5,000, $10,000, or even $1 million because you feel you've had the knowledge and you've had the demo trading experience. Start small. Okay, trading is not a get rich quick scheme. There's a higher chance of you losing your first trading account. So you don't want your first trading account to be $1 million or $10,000, because that's going to be catastrophic. So start small, lose small. Okay, gain the experience needed, gain the confidence, and then you can go ahead to start trading with a higher capital. So here's a quick summary before we wrap up this course. This is my recommended broker, Forex Time. So it's simply forextime.com. If you're interested, you can sign up with them. Check out their about section to learn more about the platform, their licenses, and the trading securities they offer. Okay, now in order to sign up, simply click on the open account, then fill out this registration form, confirm your email, your phone number, then go straight and log in. So I'm going to log in my account right now. So when you've successfully logged in, this is the section to create your trading account. Okay, so they've got 3 different accounts: the micro account, advantage account, and the advantage plus. So the major difference is that the micro account gives you an opportunity to make a deposit of $10, and for the advantage and advantage plus, minimum deposit is $200. Then in order to make deposit, click on my money, then deposit funds. Okay, so these are the various options given to me based on my country to make deposits into the platform, and these are my withdrawal options. Okay, so over here you can monitor your transaction history, make internal transfers, and also manage your wallets. So I'm just going to show you real quick here. This is it. So in order for you to actually start trading, you need to verify your account with the appropriate documents. So you need an international passport or a driver's license. You also need a proof of residence to verify your address. So until this is done, you won't be allowed to trade the forex market, or you'll be a certain limit will be placed on your account, so you'll be able to perform all operations or certain operations until your document or your account has been verified. So you can go ahead and create a demo account. So just a quick review. So try demo, you click on try demo, then you get the options. Remember, leverage is simply a tool provided by the broker to enable you trade a large sum of capital with just a small trading deposit. So leverage of 100 to 500 is recommended. So that's that. Set your balance, $1,000 recommended. Then click on open account. So that's basically how it works to open a demo account. Then for the different platforms, you can click on the platform, download platform, and you get all the different software available for MT4 and MT5 on Mac, Apple, iOS, Android, and Windows. So that's basically a quick summary of how to set up your trading account and how it works. If anything is not clear, try as much as possible to go back to the videos, watch them all over again. If you've got questions, use the question section at the end of this course, and please don't forget to take the quiz. In this section, I'm going to be showing you how to take your first trade. So I'm going to be showing you how to take a buy trade and how to take a sell trade. So we're going to be taking a look at the MetaTrader 5 platform for both mobile and desktop. Okay, so I'm going to show you what lot sizes mean, what pips mean, what take profit and stop loss targets means. Okay, so I'm going to show you what different trading orders mean. So we're going to talk about pending orders, we're going to talk about market execution, we're going to talk about pips. So don't worry about all this. I'm going to explain and try as much as possible to make them as clear as I can. Okay, so that's basically what this section is all about, to giving you a brief overview of your trading account. So we're also going to talk about your balance, your equity, your margin. Okay, so I'm going to help you understand what these terms means and how to open trades. So we're going to take a look at a practical example of how to open a buy trade and how to open a sell trade, as well as how to calculate your profit, because we'll be taking a few trades. In this lesson, we'll be talking about the MetaTrader 5. Now, from our previous course, we talked about how the MetaTrader 5 makes it convenient for traders to carry out trades. So that's the reason why most Forex broker gives you the access to link up your trading account with a MetaTrader 5 or MetaTrader 4 platform. So right now, in this lesson, we'll be talking about the MetaTrader 5 for mobile, okay? So at the end of this course, we're also going to take a look at the desktop version for MetaTrader 5. But I think the mobile version is much more convenient, and that's why we're going to be spending much time talking about the mobile version as compared to the desktop version. But we're still going to look at the desktop version. So right now, I've already installed the MetaTrader 5 on my mobile phone. So we're just going to go over it real quick to get a preview of how the MetaTrader 5 looks like, and the different features and activities you can actually carry out with on your MetaTrader 5 mobile application. So all I have to do right now is click on the mobile app, it opens, and we are given an option to open a demo account with the MetaTrader 5. But the thing is, since we're going to be opening a demo account, but we already have a demo account with our FXTM Forex broker, so we wouldn't be using this default demo account provided or recommended by the MetaTrader 5. So I'm going to click on cancel, and on the search bar, we are going to search for our broker. Okay, so if your broker has access to the MetaTrader 5 platform or the MetaTrader 4 platform, it should pop up when you search for your broker on the search bar. So I'm going to search for FXTM. So this is FXTM. I'm going to click, and remember, when we created our FXTM our demo account on the FXTM platform, we were giving our trading server and our account number, okay, which is our login details, and we also created a password. So on the screen here, on the left hand side, so on our FXTM platform, this is our Forex time server, okay, and this is our account number. So in the server section on the mobile app, just click and you are going to see the different servers available. So I'm looking at the screen here, we have a trading server demo 02. So demo 02 is on the is the last in the list on the MT5 trading terminal. So I'm just going to click on that, and I'm going to put in our login details. So I'm going to copy this. So this is our login. So it's 67131400. So I'm going to put in our password. So now we finally logged in our account. So as you remember, we opened our demo account with $1,000 balance. So that's why we're having $1,000 here as our balance, equity, and free margin. So in the next lessons, we're going to explain what balance means, what equity means, and margin. So for now, I'm just going to go over the mobile application for MT5 and show you what different section does. Okay, so starting from the left hand side, we have the quote section. I'm talking about the navigation bar at the bottom of the mobile application. So we have the quote section. This is where we get the list of all our tradable assets, so all the currency pairs, commodities, and everything you wish to trade on the MT5 platform using your FXTM broker. So right now, if you check out the list, there's no commodities like gold, for example, or crude oil. So in order for you to add gold, for example, all you have to do is click on the search bar and search for gold. And then you get gold, spot metal. So in order to add gold to the list of tradable assets, all you have to do is click on the green icon at the left hand side. So you click on green and it's added to the list. So let's say, for example, you want to add a currency pair like USDCAD. So USDCAD pops up, click on the green plus icon beside it, and there you have it. It's already added to the list. So as you can see now, we have gold and we have USDCAD. So let's say, for example, you want to add stuff like, let's say, crude oil. So you have crude oil, click on the green icon and it's added to the list. So now you can actually trade whatever item or whatever currency pairs has been added to this list. So now if you click on any tradable asset here, let's say I click on the gold, you get various options to trade it, to check out the charts, to check the details, statistics, and whatever information you need to find out on gold from your Forex broker, okay? So let's say we click on details. This is going to give you the spread, the contract size, the commissions, the fees that goes along with trading gold on the FXTM platform. So what the MetaTrader 5 does is it makes it super easy for you to open trades, close trades, follow up your trade history, and monitor your trades. So that's basically what the MetaTrader 5 does. So it brings that convenience to taking trade and monitoring your trade. So that's it for the quote section. So the next we have the chart. So the chart section shows us the price movement of gold, for example. So whatever chart you're watching, so you can check out the chart here and the price movement. So I know what you see on the screen right now might seem confusing, so with this red and green stuff. So as you move forward with this academy, you are going to learn what this actually means and how to interpret them, how to take advantage of them as a trader, and make profit from what you can see on my screen right now. So what the chart does, it shows you the price movement of whatever assets you are watching in real time. So right now the price of gold is $1,707 per ounce of gold. So that's the real time price of gold. As you can see, the price is currently moving. You can see this green line at the middle of the screen. So it shows that the price of gold is currently moving and you can jump into any trade anytime. So something interesting to also see on this side section is that when you click on this icon here, you get to instantly open a sell trade or open a buy trade. So we'll talk more about this as we move forward with this course, okay? So for now, just know this chart section lets you monitor the price movement of any asset you are trading. So let's say, for example, you want to monitor the price movement of USDCAD. All you have to do is click on USDCAD. You have the option chart. So when you click on chart, it opens up the chart of the USDCAD currency pair. And on the right hand side, you can see the exchange rate between USD and CAD currently fluctuating. So you can actually take trade actions based on this price movement. So that's what the chart section does. So next we have the trade section. So this is where you get your balance. This is where you get to monitor your trades. So whatever trades you've opened, you get to see them displayed on this section. So in the next lessons, we are going to carry out a trade and see how it actually works on this section. So for now, it's all blank. All you can see is your balance, equity, and free margin because there's currently no trade open. So by the time we open a trade or two, you would be able to follow up those trades here. So you'll be able to edit the trades, you'll be able to close the trades, you'll be able to set take profit and stop loss. So the terms take profit and stop loss, I'm also going to explain that to you as you move forward with this course. So that's basically what the trade session does. So next we have the history section, and this is where you get to see a summary of all your trade activities. So deposits, withdrawals, both the trades closed in profit and in loss, and you're going to get a summary of all your trades, okay? So both the winning trades and lost trades. You're going to get a summary on what you've made or what you've lost in this section, and you can also filter by time, okay? So that's it about this section. So just a quick summary before we move on to the next lesson. Code section shows you a list of all the currency pairs or commodities or trade assets you're watching, okay, or you're interested in trading. Then the chart session gives you a real-time price. It displays the real-time price movement of the exchange rate between currency pairs or the price of any commodity you are watching. The trade section is where you get to monitor your open trades and also get to close those trades. Okay, you get to also edit your trades. So it gives you a breakdown of all the trades you are running and whatever decisions you would like to make regarding those trades, whether you have to close them, whether you have to edit the trade, set take profit or stop loss levels. While the history section shows you a summary of all your closed trades, including deposits and withdrawals. Then you have the settings. So settings is a section where you get to monitor your account. So let's say, for example, you can add a new account. So if you have a live account in Forex Time, you can also log in your live account, FXTM. I'm going to search for FXTM. So on the server, you see you have 2 live servers. So when you create a real account on FXTM, for example, you're going to be given a server in which you'll be carrying out your trades. So when you get a server, all you have to do is come to the MT4 platform, log in a server with your username and password, and you get access to your real account. So you can actually add up to 5-10 different trading accounts on your MT4 and switch among those accounts whenever you like. Okay, so that's one of the benefits of having the MetaTrader 5. It makes it easy for you to manage your trades and manage your trading accounts. So that's basically everything you need to know about the MetaTrader 4, how it works, how to navigate through the different sections of the platform. As we move on with this course, you're going to learn more details on how and what this trade section entails, and how to actually open a trade, close a trade, and how it looks like to have a running trade and open positions. In this lesson, I want to briefly talk about the trade section on our MT5 trading platform. Okay, now on the screen here you can see balance, equity, and free margin. And this is really important to understand because we're going to be seeing these titles as we move on with our trading. Okay, now in the previous lesson, remember I said the trade section helps us monitor our trades and gives us the ability to make changes to our trades or close our trades. Now obviously, balance simply means your total deposit or your total trade capital. That's what balance means. While equity is simply the sum of all your open trades plus your balance. So the sum of your open trades and your balance. So if your open trades are running a total of $100 in profits and your balance is $1,000, so your equity would be $1,100. Okay, so if the total trades you're running, it's running at a loss of, let's say, $250, so it's going to be minus $250 plus your $1,000 balance, which will be $750. So equity is simply the addition of your balance to whatever profit or loss you are running on your trading account. While margin is simply a set of funds set aside to open a trade. So I know it might not be clear right now, but as we move on with the course, you are going to understand what margin means. So the reason why we're having free margin right now is because there's no current margin taken off your account because no trade has been opened yet. So your free margin is the same as your balance because no funds has been deducted from your account or set aside from your account to carry out any trade. So basically, just to repeat once more, margin is simply a set of funds kept aside from your account in order to run a trade. As we move on with the next lessons, you are going to understand clearly what equity, margin, or free margin means. Okay, so free margin is simply the amount of money left to open trades. So let's say, for example, to open a particular trade, you need $200. Okay, now $200 is going to be set aside from your account, which will be deducted from your balance. So your margin will be $200, which is set aside to open a trade. Then your free margin will be $1,000 minus the already set aside $200, which will bring your free margin to $800. So you have $800 more to open more trades. So that's basically what balance, equity, and free margin means. So it might not seem very clear right now, but in the next lessons, as we open trades, you are going to understand clearly what this means. So I just wanted to give a brief intro on what balanced equity and free margin means. So when we explain further in the next lessons, it wouldn't sound new or foreign to you, okay? So that's it for this lesson. See you in the next lesson. In this lesson, we'll be talking about trade orders, okay? So now, trade orders are simply the different ways in which we can open trades using the MT5 trading platform. So in order to go to this section where we can actually carry out trades, all we have to do is come to the quote section. So when you click on the quote section, then let's say for example we want to take a trade on gold. So gold is simply XAUUSD. So we click on that and you get a list of options. Then we click on trade. Now this is the trade section. In the next few lessons, we're going to be talking about everything we can see on my screen right now. So in the first section, we have the market execution. Then we have the these digits just below the market execution, -5, -1, 1.0, +1, +5. This is known as the lot size section. So I'm going to explain what that means. Then we have the stop loss, we have take profit. Then we have sell by market and buy by market. So I'm going to explain what all this means and how we can, actually fill in this information in order to successfully open either a buy trade or a sell trade. So in this lesson, we're going to be focusing on the first section, which is the order section. So in the order section, we have the market execution. What this market execution means is that it's a type of market order whereby you open a trade instantly at the current market price, okay? So let's say, for example, you want to take a market execution trade. This means with the current price of gold at 1735, so as you can see on my screen, under the sell by market and buy by market section, you can see the price of gold is at 1735. This means if I should click on the sell by market button right now, a trade is going to be opened instantly at this current price. Okay, so sell by market simply means we are predicting that this price of gold is going to decline over time, and we can decide to close the trade whenever we like, whether we're in profit or in loss. So if we click on the buy by market, this means the price for gold currently showing above the buy by market button. I've highlighted that right now. It means if we should click the buy by market button, a trade is going to be opened instantly right now at the current price. So this buy by market simply means we are predicting that the price of gold is going to rise in value over time. Now there are different type of trade orders. I just explained the market execution. So if we should click on the market execution right now, you can see a list pops up. So we have the buy limit, we have the sell limit, we have buy stop, we have sell stop. We also have the buy stop limit and sell stop limit. So you're basically not going to use this buy stop limit or sell stop limit. So what I'm going to be focusing on right now is the buy limit, sell limit, buy stop, and sell stop. Now, this set of orders are known as pending orders, okay? The reason is because when you use this type of order, so I'm talking about the buy limit, sell limit, buy stop, and sell stop right now. So when you use any of these orders, it means your trade is not going to be opened immediately you click on the buy button or the sell button, and I'm going to explain why. Now this is what buy limit means. Buy limit simply means you are looking forward to open a trade at a price lower than the current market price. Looking at the bottom of the screen, the prices you see on top, the sell by market button and the buy by market button, are the current market price, okay? So right now we have a price of $1736 per 1 ounce of gold. So that's the current price of gold, okay? So what buy limit means is that you would like to open a trade at a price lower than 1736. So let's say, for example, you are going to your office, or you are going on a vacation with your family, and you would like to take a buy trade at a price of 1700, okay? So 1700 is the price of gold you would like to buy at. So you're expecting the price to drop in value, to get cheap, and at 1700 you would like to open a trade. So buy limit lets you automate your trade order, okay? So I'm going to click on the buy limit right now. So if I click on the buy limit, you see the screen has changed. So we get the option to place our price. So that's right here. So right now, with the current price at 1736, all you have to do is put your price of 1700 and click on place. So when you click on this place, the trading firm or the trading platform, which is the MT5, is going to automatically open a trade for you when price gets to this level of 1700 or 1700. Okay, so I'm just going to try something out. If you should put a price higher than the current market price, so we have the current price at 1736, so I'm going to try 1750. As you can see, the place button is blanked. Why? Because for a buy limit order, we can only take a trade when the price is lower than the current market price. Okay, so we can only take a buy trade when our anticipated price is lower than the current price. That's when we can take a buy trade. So that's the reason why the place button is blank. So if you take a lower price lower than the current price, so 1700, you see we get the option to take the trade. So if I should click on this place button, the trade would not be opened instantly. Why? Because the current market price is not at this anticipated price we intend to open our buy trade at. So MT5 is going to automatically, set up this order for you. So even if you're on vacation, you're not on your screen, you have no access to the internet, by the time you come back from your vacation, if the price of gold falls to 1700, the MT5 platform is going to automatically help you open the trade, even if you're not online. So that's the purpose of pending orders, and this is what buy limit means. So moving on, sell limit. So sell limit is simply the opposite of the buy limit. This means you are willing to sell at a price higher than the current market price. Okay, you are willing to sell at a price higher than the current market price. So let's say, for example, the current price is 1736. So in order for you to place a sell limit, you will have to, sell at a price higher than the current price. So I'm going to try 1750. So let's say for example, we would like to sell at 1800. So all I have to do is 1800 and I can place this trade. So what this means is, when I click on the place, the trade is not going to be opened instantly. Okay, the MT5 is going to wait for the price of gold to appreciate to a higher value, which is 1800, as we have set it on the order, and then automatically help us open a sell trade, predicting that the price is going to go down. So that's what sell limit means. Okay, and that's why it's called a pending order, because it's automated and it does not let you open the trade instantly. Now moving on, we have a buy stop. So buy stop is simply a situation whereby we would like to open a trade at a price higher than the current market price. Okay, now let's say, for example, gold is currently at 1736. So a buy stop simply means we want to buy at a price higher than the current price. I know you might be thinking, why would you want to buy anything at a higher price? So you're going to learn these techniques, okay, while as you move forward with the academy. So you get to see reasons why you want to, buy or carry out a buy trade at higher prices. So let's say, for example, in order for the buy stop to work, it means you have to select a higher price. So it means, since the current price is at 1736, you can possibly choose to go into a trade at 1900. Because this is a higher price. So if you take a price that is lower than the current price, it's not going to let you place the trade. So I'm going to try 1500. So as you can see, the place button is blank because the price at which you are willing to open a buy trade is lower than the current market price. So that's not what buy stop is meant for. Buy stop is meant to help you open a trade at a price higher than the current market price. So the current market price is at 1736. So you can therefore put a buy stop order at 1800, for example, or 1900, or even $2,000. Okay, so this is what the buy stop order is meant for. So lastly, we have the sell stop order. So this is the opposite of the buy stop. This means you are willing to open a sell trade at a price that is lower than the current market price. Okay, so the current price is $1,736. So it means you will be able to set up a trade that would open a sell trade that will open when the price goes lower. So let's say you want to open a sell trade when the price goes lower to 1,600, then you are going to be allowed to place this trade. So even if you are not online, you are not with your computer, you don't have no access to the internet, the MT5 platform is going to automatically help you place the trade when the sell trade when price gets to 1,600. So that's basically what the different trade orders. Trade orders is simply the different ways in which you would like to open a trade. So market execution is the most popular one, and that's what I recommend for new traders. Okay, so you don't have to play with penny orders right now. So you don't have to play with buy limit, sell limit, buy stop or sell stop. I'm just doing this for you to understand what these different orders means. So as a beginner trader, you will be focusing on market execution. As you move forward with this academy, as you begin to get experience with trading, then we'll talk more on pending orders. So market execution, once more, is a type of order whereby you get to buy and sell at the current market price. So there's no waiting. So when you click the sell button, you automatically open the trade. When you click the buy button, you automatically open the trade. So clicking the sell by market simply means you are predicting that the exchange rate is going to decline from this price. Okay, if you click on the buy by market button, it means you are predicting that the exchange rate is going to increase from this current price. So that's it for trade orders. In the next lesson, we're going to be talking about lots and lot sizes. So that's the -5, -1, 1.0, +1, and +5 that you can see on my screen right now. So in order for you to successfully open a trade, these are the things you need to go through. So you need to put in these details in order to give your broker an instruction to say, this is what I want my trades to be about. Okay, so don't worry about lot sizes, don't worry about stop loss, take profit. I'm going to explain what all this means as we move on with this course. So that's it for trade orders. In the next lesson, we're talking about lot sizes. So in this lesson, we'll be talking about lot sizes. Remember in the previous lesson, we talked about market execution. So market execution is a type of order that, lets us open a trade, either a buy trade or a sell trade instantly on the current market price. Okay. Now, what lot size does is that this is where we choose how much quantity of a particular currency we are willing to buy or sell in order for us to open a trade. Okay, so I'm going to repeat once more. Lot size is the quantity of a particular currency we are willing to purchase in order to open a sell trade or a buy trade. Now, in this section, you can see -5, -1, 1.0, +1, and +5. So I'm going to explain what all this means. So before we get there, in this example, we're going to make use of the USD CAD currency pair. So the US dollar and the Canadian dollar. And currently, the exchange rate between the US dollar and the Canadian dollar is 1.302 or 1.3019. So the price is currently fluctuating, but I'm just going to pick a base. So let's say the exchange rate between the US dollar and this Canadian dollar is 1.30. This means we need 1.30 Canadian dollar to purchase $1. Okay. Now, let's say, for example, we want to open a buy trade of $1. This means in order for this to be possible, we will need to pay 1.3 Canadian dollars to purchase $1. And if the exchange rate grows to, let's say, $1.5, it means we have made $0.2 on our trade. Okay, so that's just a rough sketch. So I'm going to explain in details now. So since we know that the exchange rate between the US dollar and the Canadian dollar is 1.3, it means we need 1.3 Canadian dollar to purchase $1. But we can't make significant profit like this, trading $1, $5, $10. This is where lot sizes comes in. Okay. Now, the forex market is made up of the big players, and in order to make significant profit, we need to, get into trade with huge sum of, capital. This is where the lot size comes in. So at this point, one lot simply means 100,000 units worth of currencies. So in the lot section, instead of having to write $100,000 worth of currency as our as a quantity of currency we're willing to get into the trade with, we can simply use one lot. So in forex trading, one standard lot simply means 100,000 units. So if you're going to open a trade with one lot, it means you are going to open a trade with 100,000 units worth of US dollar. So let's say, for example, we want to open a buy trade. So we have to click the buy by market. So since we have the one lot set as our lot size, or as our trade size, and we have the market execution, it means by the time I click this buy by market button, a trade will be opened, giving instruction that we are buying $100,000 worth of currency with this exchange rate. Okay, so if we are buying $100,000 worth of currencies, it means we are paying 130,000 Canadian dollars to purchase $100,000. Okay, now I know you must be thinking, but our account balance is just $1,000. So how is it possible for us to actually buy $100,000 worth of US dollars? That's a great question, and this is where leverage comes in. Now, remember in the previous course when we opened our demo account, we chose a leverage of 1:500. Now, what this simply means is, in order for us to open this trade, we need just $200. Now, this is how it works. Now, we are going to divide $100,000 by 500, since 500 is our leverage. If you divide $100,000 by 500, you're going to get $200. So, in order for us to control a trade worth $100,000 by, using the one lot size, we are only required to, make a small deposit of $200 to open these trades. And the $200 we are required to, set aside to open this trade is known as our margin. So I know in the previous lesson, we talked about margin and free margin. So I know it still might be confusing right now, but when we, successfully open a trade, I'm going to explain and show you everything on the trade section in our MT5 platform. So I'm going to explain once more, okay? The lot size is simply the quantity of currencies you are willing to get into a trade with. One lot is a standard lot, and it means you are going to, open a trade with 100,000 units worth of currencies. Now, in this case, for USD, using a one lot to open a buy trade means we are predicting that the exchange rate between US dollar and Canadian dollar is going to rise, and we are staking 100,000 units worth of US dollar for this trade. So whatever price the exchange rate rises to is going to be multiplied by the total number of units we are using to open this trade in order for us to either make profit or loss. So using a one lot size for this trade is a very, very risky trade for our account, because we are having just a $1,000 account. Okay, so imagine having to set aside $200 from $1,000. That's a very huge risk. Now, we can also go as low as 0.1 lot size. Okay, 0.1. So I just wrote that on the screen. So what this means is we are going to open a trade with 10,000 units worth of currencies. Okay, now remember, one lot is simply 100,000 units. 0.1 lot is 10,000 units, and we can also go as low as 0.01 lot. So 0.01 lot is simply 1,000 units, and trust me, this is still enough to make us significant profit. Now, in order for us to open a trade with 0.01 lot, it means we only need to set aside $2 to open a trade with 0.01 lot. So just a quick breakdown. So 0.01 lot is 1,000 units worth of currencies. So it means we are buying $1,000, okay, against the Canadian dollars, and dividing $1,000 by 500, since our leverage is 500, that gives us 2. So we only need $2 to open a trade worth $1,000. And if we are going to take this trade with one lot, we only need $200 from our $1,000 to open a trade worth 100,000 units worth of US dollars. So that's basically what lots are. And below this video, we're going to attach a PDF file to also elaborate more on lot sizes and how to calculate them. So now, I don't want you to bother yourself about calculating lot sizes, because the broker automatically does this for you. But what you need to understand is that the higher the lot size is, the higher the risk. So just as you can make significant profit using higher lot sizes, you can also make significant losses, and we are going to explain all this as we move forward with the course. Now, just a quick recap, okay? One lot is simply 100,000 units worth of currencies. 0.1 lot is 10,000 units worth of currencies, and 0.01 lot is 1,000 units worth of currencies. So for a $1,000 account for a beginner trader, you shouldn't trade with more than 0.01. So you can go for 0.02, you can go for 0.03. So it's not just a one-digit difference, okay? So it could be 2 lots. So it could be 2 lots, it could be 5 lots, it could be 10 lots. So 10 lots means 1,000,000 units worth of currencies. So that's it for lots. And if you are wondering why you can open a trade worth 100,000 units worth of US dollar, simply remember that we are using a leverage of 1:500, which means whatever trade we want to open will be divided by 500. So for a 100,000 units worth of trade, either a sell trade or a buy trade, it means 100,000 divided by 500, since that's our leverage, gives us 200, which means we only need 200 to open a trade worth $100,000. So that's the beauty of Forex, and the reason why it's enticing, because in order for us to actually control huge sum of capital to make significant profit, we only need to set aside a little bit of capital. So this is what we're talking about from our earlier courses, talking about leverage and margin and all that. So as we move forward with the course, we are going to talk about stop loss in our next lesson and take profit. So when we are done with stop loss and take profits, then we are going to try out a trade. So we are going to open a buy trade, we're going to open a sell trade, see how it works, see how the profit is actually calculated, then get to see margin for real and how it works. So that's it for this lesson, guys. See you in the next lesson. Now we're going to talk about stop loss and take profit. So we'll be starting with stop loss, okay? For example, you open a trade, or let's say you take a buy trade to potentially make you $1,000 profit. Now, if you find out that this trade is going in the opposite direction and you've lost $200 so far, your instinct will tell you to close the trade, right? So let's say, for example, you open a trade, a buy trade, and instead of the exchange rate to increase in value, it decreases. So the trade going in the opposite direction of your prediction. You are thereby, responsible to close your trade so you don't lose the entire trade capital or your trading balance. So stop loss lets you automate this process. So let's say, for example, you open a trade and you are going out with friends or you are going to the beach. There's a probability that this trade might go in the opposite direction of your prediction, but you might not be online to close this trade. So stop loss lets you put in a predetermined price level where the trading platform or the trading terminal, which is MT5, would help you close out your trade when you lose a certain amount of money, okay? So you can set a price target whereby if a trade goes in the opposite direction and you've lost $100, MT5 will automatically help you close the trade. Because if you don't close this trade and you let this trade continue to run at a loss, you would eventually end up losing your entire balance. So if you have a $1,000 trading account, a $1,000 balance, and you open a trade without using stop loss and you forget about this trade, maybe you get carried away by visitors or by going out to the beach or by going out with friends and you forget about your trade. If this trade goes in the opposite direction of your prediction, you might end up losing your entire balance. So that's why stop loss is important, because it helps you mitigate losses. It helps you reduce the risk of exposing your account to losing all your funds. So if you open a trade, you can set a stop loss saying, at this particular price, I want these trades to be closed because I don't want to lose more than $100 of my balance. I don't want to lose more than $250 on this trade. So that's basically what stop loss is all about. It lets you automate your trade so that you can get a maximum loss on a particular trade. So you can decide to say, on this trade, I don't want to lose more than $50. So you can set your stop loss at a price that would automatically close your trade when you lose $50. So that's it for stop loss. So now we'll talk about take profit. Take profit is the opposite of stop loss, okay? So take profit lets you automatically close your trade when you make a certain amount of profit. So let's say, for example, you open a trade and your profit target is $200, and you know you would probably not be available online to close your trade at a $200 profit. So you can set the price target that will get you $200 profit. So when price goes to these price levels, the trading platform or the MT5 platform will automatically close your trade at a $200 profit if that's the price you set, okay? The reason why you want to do this is because sometimes when you open a trade, you might make so much profit, maybe even up to a $500 or a $1,000 profit, for example. But when you fail to close this trade, maybe you forget that your trade is open, price could reverse, or you could end up making $50 if you don't close the trade at a $200 profit, okay? So I'm going to repeat myself. You could take a trade and make a $1,000 profit, but without closing that trade, it's not guaranteed yet, and the money will not be added to your account, okay? So if you forget to close this trade, you might end up closing the trade at a $50 profit because the exchange rate is always fluctuating. So that's it. That's the importance of using take profit levels. So if you know you're going to take a trade and you might be asleep as at the time you make $200 profit, or you might not be available to close the trade at $300 profit, you could set a price to automatically help you close the trade when you make that amount of profit. So that's basically what stop loss and take profit does. Stop loss lets you automatically close your trade at a particular price level to help you mitigate losses, okay? So you can set your trades to lose a maximum of $50, a maximum of $100, and the trade is closed automatically. While take profit lets you close your trade when you make a certain amount of profit. So that's it for these lessons. We've talked about market execution, we've talked about lot sizes, we've talked about stop loss and take profit. So in the next lesson, we are going to look at how to actually open a trade using these parameters. And something very important to also note is that you can open a trade without using stop loss and take profits. Okay, so using your market execution and setting your lot size, you can simply open a sell trade or open a buy trade. So it's not compulsory to set stop loss or take profit, but it's recommended to set stop loss because it would help you mitigate losses if your trade predictions goes in the wrong direction. So that's it for this set of lessons. So in the next lesson, we're going to open a buy trade and open a sell trade to see how it really works on the MT5 platform, and to see more examples of margin and leverage and how profit is being calculated. So in this lesson, we'll be taking a sell trade and we'll be taking a buy trade. Remember from our earlier lessons, we said a sell trade is predicting that the exchange rate is going to decrease in value, while a buy trade is predicting that the exchange rate is going to increase in value. So for the sake of this example, we will be using the Euro USD currency pair. So the Euro against the US dollar. Now, the current exchange rate between the Euro USD is 0.9986. Okay, so we're going to go ahead to take a sell trade and a buy trade right now. So we'll be using a lot size of 1.0. So we're going to using 100,000 units worth of currencies to go in for this trade. Remember, guys, for a $1,000 account, do not attempt to trade with a one lot trade size. Maximum lot size should be 0.01 lot, okay? But I'm using one lot right now just so the example and the explanation I'm going to make right now is clear enough. So we're not going to set any stop loss or take profit. We're just going to open the trade because we're currently online and we can close the trade whenever we like. Okay, so I'm not going to set any automated stop loss target or take profit target. So we're going to go for the sell trade first, and then we're going to go for the buy trade. So I just clicked on the sell trade, and now the trade has opened. And you see we're currently running a -10, -8 dollar loss. So it's currently fluctuating, and I'm going to go over to take a buy trade now. So going back, Euro USD trade, and I'm going to buy same one lot, buy. So I just bought for one lot now. Okay, so what this means is we have two running trades. So one trade, the buy trade, is currently at -$31, and the sell trade currently at $10. Okay, so the exchange rate between Euro USD is currently fluctuating. That's why we have the loss right now moving so fast. So we might see our sell trade going in profit soon, or our buy going in profit, but right now we are currently running at a loss. So what you can see at the top of my screen here, you can see -$35. This is our total loss on this trading account. Okay, so we have a loss of -$5 on the sell trade and $30 on the buy trade. That's why cumulatively the total trade position right now is running at -$35. You can see at the top of this screen. Okay, so it's fluctuating. It's at 30, 35, 43, 42, and so on. So now if you're taking a look at the balance, our balance is still showing us $1,000. The reason is because we haven't closed our trade. That's why we have a balance of $1,000. So not until we close this trade, our balance is going to remain at $1,000, because the loss has not been deducted from your account yet. So moving down on the equity section, you can see our equity is currently at $965. This is because equity shows you your real net worth. Okay, so your balance plus or minus your running trades. So right now our running trade is at -$35. So $1,000 minus 35 is $965. That's why our equity is showing us $965. So this means if we were to close both trades, if we were to close both our Euro USD buy trade and Euro USD sell trade, we would be left with a $965 balance. Okay, that's what equity means. So equity shows you the real value of your account. While margin is the amount of funds set aside to actually carry out these trades we are running on our trading account right now. So that's what margin means. Okay, so you can see the margin is showing us $199, which is approximately $200. Yeah, so yeah, that's it for our margin. Okay, so free margin is currently at $765. That's because that's the amount of funds we have left to carry our trades. So the free margin is simply the normal margin has been set aside, so we're supposed to be left with about $800 to open more trades, but we are currently running at a -$35 loss. That's why our free margin is reflecting $765. So free margin is the money set aside to actually control these two trades that we are currently opened right now, while free margin is the amount of capital left in our account to actually open more trades. So now taking a look at the Euro USD sell trade, if you click on that, you're going to get options. Okay, so now below here you can see an option to close position. So if you click on close position, you are going to be given an option to close this trade right now at a loss of -$25 or $16. So the value is fluctuating right now. So this is how you actually close your trade. Okay, so going back, so if you click again, so you have the option to modify your position. So if you click on modify position, you can adjust your stop loss, you can adjust your take profit. So let's say, for example, after opening this trade, I'm about to leave the house, or I'm about to lose internet connection. So I can simply set a price at which the trade is going to be closed. So even if I'm not online, this trade will be closed automatically when when Euro USD gets to a particular price, so my losses will be mitigated. I can also set a take profit target, so the trades will be closed automatically when a profit target is met at a particular price. So that's it for modifying your trade. So just to go over it one more time, click on the buy, for example, this time. So you can close your position by clicking on the close button. Then you can see close by one lot by market with a loss of -25 or -$22, as the case may be. You can also decide to reduce your position. Okay, so even if you don't want to close everything, you can decide to close half. In this case, to do is reduce your lot size to 0.5, because right now your lot size is at 1. So if you reduce to 0.5, then you would close half of your position, because 0.5 is half of one lot. But we wouldn't be closing any of these positions right now. So I'm just going to be patient a little to see if any of this trade is going to be in profit, so we can actually close a trading profit. So I can use this as an example to explain how profit is being calculated and how your loss is being calculated. So that's why I opened both a buy trade and a sell trade on the same currency pair. So I'm just going to wait for a few minutes to see how it goes. So when we close this trade, we would be able to make an example or an explanation on how profit is being calculated. So something else to also mention here that I didn't mention earlier is that when you click on this Euro USD, for example, any of the trades, so I just click on the buy, so you can also click on the sell. So it gives you a breakdown. Okay, so what we can see at the left hand side is the price at which we entered the trade, which is 0.99828. So since this is a sell trade, we are predicting that the exchange rate is going to reduce in value. But if you check at the right hand side, the new exchange rate is at 0.99833. So it's still a bit higher than our entry price. So it has gone below now. So that's why you can see the price or our profit at the right hand side, extreme right, is in blue. So whenever it's in blue, it means you are making profit, and whenever it's in red, it means you are making a loss. So it's currently at $32 profit, $29 profit, 27, 35. So it's fluctuating really fast because the exchange rate between Euro USD is fluctuating fast as well. Okay, so if you take a look now, we entered at 0.99828. Price is currently at 0.99782. So that means the exchange rate between Euro and USD is currently lower than the exchange rate at which we opened the trade. So we are in profit because the trade is going in our direction. Okay, so I'm going to use the other trade as an example now. So Euro USD, the buy trade we open. Okay, so the buy trade means we are predicting that the exchange rate between Euro USD is going to rise in value. So we opened the trade at 0.99842, but the current price is at 0.99754. So since we said the exchange is going to increase, but right now the exchange rate is going in the opposite direction of our prediction, because as you can see, the current rate 0.99742 is lower than our entering price of 0.99842, which means the trade is going in the opposite direction of our prediction. So right now I'm going to close this both trades. So currently at $80 profits, I'm going to close position, close this. So we've closed our Euro USD, and I'm going to close the other Euro USD now. So close positions. So yes, so we've closed both trade, and now if you check, the balance is at $975 and our equity is at $975. Why? Because the loss has been deducted from our balance, leaving us with a $975 balance. So in order for you to check your trade, all you have to do is click on history, and you can see a breakdown of our two trades. So the sell trade we took with one lot made us $70, while the buy trade we took with one lot made us a loss of $95. So cumulatively, $70 profit plus $95 loss gives us a total of minus $25. So we made a loss of $25. Yeah, we made a loss of $25. So if you go back to trade, so $25 plus 975 would give you $1,000. So that's how the calculation is being done. Okay, so in the next lesson we're going to explain in details how the profit is being calculated and how the loss is being calculated. So I'm just going to click here. So it's just a summary. Okay, so when you click on the sell trade, so area USD sell, as we can see at the bottom of the screen, we entered the trade at 0.99828, and we predicted that the exchange rate is going to decline in value, and it actually declined, going down to 0.99758. So we're going to explain how the profit is being calculated in the next lesson. So just a quick breakdown. Click on the buy trade. We can see that we entered the trade at 0.9984, predicting that the exchange rate is going to increase in value, but it's actually decreased to 0.99747. So we made a loss of $95. So that's just it about opening trade, closing your trade, and how to modify your trade or change anything regarding your trade. And you can do that in the trade section, and the history section is meant to help you get a history of all the trades you've opened. Meanwhile, this trade we just carried out, these two trades we carried out, were just based on speculation, okay, or just based on gut feeling for the sake of this explanation. So no analysis was carried out. We just went to the area USD and bought and sold. So that's not how trading is meant to be done. You are not supposed to carry out trading based on guesswork, based on gut feeling. Analysis are supposed to be carried out, in-depth analysis, so you are at least 80% sure that yes, this trade you are going to open is going to make you profit. The purpose of trading is to make profit and not to make losses. So if you should go ahead and start buying and selling the way we just did right now, you would eventually definitely end up in losses. So that's the reason why you've enrolled in our academy. We are going to teach you everything you need to know about analyzing the markets and coming up with accurately and well predicted trade entries so you can make profits. So that's it for this lesson. In the next lesson, we're going to explain how our profit is being calculated by the trading platform. So in this lesson, we'll be taking a look at how our profits and loss are being calculated. Okay, so we're starting with $70. So let's take a quick look at how we made $70 and how the calculation is being done behind the scene. So remember from our previous lesson, we took a trade on Euro USD sell. Okay, so we took a sell trade on Euro USD for one lot, and remember, one lot simply means 100,000 units worth of currencies. Okay, now clicking on the Euro USD sell trade, I'm just going to click that now. What we can see at the bottom of my screen is a breakdown of our trade and how everything went down. Okay, on the left hand side, we can see we entered the trade at 0.99828. Okay, so that's the price at which we entered the Euro USD sell trade, or the exchange rate at which we entered a sell trade for Euro USD, which means we are predicting that the exchange rate is going to decline from this exchange rate downward, okay, in order for us to make profit. So that's what sell trade means. So at the end of the trade, we ended up closing the trade at 0.99758. So this means the exchange rate actually declined from 0.99828 to 0.99758. Now, the way our profit is being calculated is that we subtract the lowest exchange rate from our entry price, okay, because obviously we entered at a higher exchange rate and we closed our trade at a lower exchange rate. Okay, so when we subtract 0.99758 from 0.99828, we get 0.007. Now when we multiply 0.007 by 100,000, we get 70. Did you get that? So I'm going to repeat myself. Okay, so when we subtract the exchange rate at which we closed our trade from the exchange rate at which we entered, we get 0.007. So remember, we entered the trade with one lot, okay, and one lot size simply means we are entering with 100,000 units worth of currencies. So this 100,000 units worth of currencies will be multiplied by 0.007 because that's the movement we made from our entry. So when you carry out this multiplication, we get 70. So that's how we got our $70 profit. I hope that's clear enough. So I'm just going to make a quick example again with the buy trade we took. Okay, so we just explained how we made $70 with the sell trade. So I'm going to take another example. So I'm going to explain again once more with the buy trade we took to explain how we lost $95. So here we go. Looking at our buy trade for Euro USD, we also bought with one lot, okay, which means we bought with 100,000 units worth of currencies. Now we entered the trade at 0.99842 and we closed the trade at 0.99747. So this means we actually closed the trade at an exchange rate lower than our entering price when we carried out a trade predicting that the exchange rate is going to rise in value. So now the exchange rate went in the opposite direction of our trade, which means ran at a loss. So when you subtract 0.99747 from 0.99842, we get 0.00095. So if 0.00095 is multiplied by 100,000, because the one lot size we use to open this trade is 100,000 units worth of currencies. So therefore we multiply 0.00095 by 100,000 and this gives us $95. But because the trade went in the opposite direction of our trade or our prediction, it ended up as a loss because it didn't go in the expected direction. Okay, so if this went in the expected direction, which means if we took a sell trade and the exchange rate actually went below our entry price or the exchange rate at which we entered the trade, then this minus $95 would have been a profit for us. But just because we took a buy trade predicting that the exchange rate is going to go higher, but it actually went down, so therefore the trade ended in a loss. So if you subtract the exchange rate at which we closed the trade from the exchange rate at which we entered the trade, then we get 0.00095. And when we multiply 0.00095 by 100,000, then we get $95. But it's a minus $95 because the trade went in the opposite direction of our prediction, okay, of the trade we took. So that's how profit is being calculated. On the left hand side of the screen, you see we also, carried out this calculation so that you can follow accordingly as I, made these explanations. Meanwhile, something very important to understand here is that when you start or begin your trading career, you are going to come across with a term known as pips. And I'm going to explain what pips means in a bit. Now, remember, when we carried out this subtraction for the buy trade, we ended up with minus 95, okay? This minus 95 is known as pips. So we ended up with minus 95 pips. So I'm going to click on our sell trade. So when I open the sell trade, as you can see, after the subtraction was done, so subtracting 0.99758 from 0.99828, we got 70. So we made 70 pips. So what is a pip? A pip is simply the unit of measurement for exchange rates between currencies. So when an exchange rate between two currencies moves, it moves in pips. So that's how we measure them. So when the price of gold moves from, let's say, 1,700 to 1,500, it moves in ounces. So in the real world, so you say, okay, the price of gold is now 1,700 per 1 ounce of gold. When it comes to, trading the Forex market, we use a measurement known as pips. And pips is simply the movement or the fluctuation in prices of exchange rates. So therefore, when we carried out our subtraction, we ended up with 70 pips for the sell trade, which was multiplied by 100,000 to give us our $70 profit. And for the buy trade, we ended up with 95 pips. Okay, so whenever you carry out subtractions like this or calculations like this, or whenever the exchange rates between two currencies make a move, they move in pips. So a pip is the measurement unit used for the calculation of exchange rate, okay, when they move. So that's it for this lesson. This is a quick breakdown on how profit is being made, how loss is being made, and how it's being calculated. I believe by now we have shed more light on the previous calculation we made when we're talking about how profit is being made in the forex market. I believe this is clear enough. In the next lesson, we would be taking a look at the MT5 platform for the desktop traders. Okay, so if you're going to be working on a desktop, I'm going to be showing you how MT5 works on the desktop. So it's going to be a short video where I explain the different functions, how to log in and all that. So that's it for this lesson. I hope this was clear enough. Meanwhile, at the bottom of this video, there's going to be a breakdown of the calculation, well explained, so you can go through that over and over again. In this lesson, we'll be talking about the MT5 trading platform for the desktop traders. Okay, so if you're using a Mac or a Windows, this lesson is going to show you how to navigate through the MT5 trading platform on your desktop computer. Now, the first thing we have to do is download the application from the FXTM platform. You could as well go to the MT5 website to get the software downloaded for your respective device. So I'm using a Mac, so I already downloaded the MT5 for Mac using this download button here. So now I'm going to go over to our account overview so we can take a look at our demo account details, because we would need these details to log into the MT5 trading platform so we can get access to our already created demo accounts on FXTM. So I'm just going to go over to the MT5. So I already downloaded the MT5. So this is how it looks when you open your MT5 software. So you're going to get access to open a quick demo account provided by the MetaTrader 5 platform. So this is how it looks. It looks a bit messy, so this is the reason why I actually prefer the mobile version compared to the desktop version. Although in the desktop version there are a lot of tools, lots of helpful tools that you wouldn't get on the mobile version. Okay, but what I do with the MT5 is simply to open trades and monitor my trade and track my trade history. That's all. So whatever other tool I need, I can get them elsewhere in a more friendly environment. So I'm going to also talk about that as we move on with this academy. So for now, let's take a look at the MT5 trading platform for the desktop traders. Okay, so this is it, guys. We are currently running on the demo account provided by the MT5 platform. So this is kind of like the default demo account in order for you to get access to the tools. So in order for you to log into your FXTM trading account, all you have to do is come to files. So under files, you go down to login trade account. So I logged in our accounts before, so our details are kind of saved here already. So I'm just going to click on server. So in order to do this, all you have to do is just come over to your FXTM account and copy our login. So this is our user ID. So copy. We go back to MT5 and we paste. So paste, and our server is on demo 2. And I'm going to put in our password here. So that's it, and I think we are in. Okay, so right now this is our FXTM demo account already logged into the MetaTrader 5 for desktop. I know it looks messy, so I'm just going to go over it real quick. I don't think you will be using the desktop version, but for those who are interested in using the desktop version, that's why we have this lesson for you guys. Okay, so right now, as you can see, you can move your charts all over the screen. You can it's flexible. You can have more than 3 different charts on your screen in order to carry out analysis for different trading pairs at the same time. But for now, I'm just going to get rid of most of them and we're going to trade with one. Okay, so this is a full screen now. So I just put the Euro USD trading pair in a full screen. Okay, so in order for us to check our account balance, our history, and those things that are associated with our account, all you have to do is come down to this lower section. So click on trade. So trade gives you access to your account balance, your equity, and all those information you would have in your mobile app if you're using your mobile app to carry out your trades. Okay, so now clicking on trade at the extreme end here, so you can see our balance. We have $975. Okay, so this is the balance left after we carried out those buy and sell trades in the previous lesson to explain how it feels to take trades. So that's nice $75 we have here. So we have our equity and we have our free margin. So you can come over to history. So if you click on history, you can see we deposited $1,000, which was our initial balance for the demo account, and we have Euro USD sell and we also have Euro USD buy. So these were the two trades we took in our previous lesson. So over here you can see we made $70 and we also lost $95, which brought our total loss to minus $25 towards the $975 balance. So this is how to navigate through your account balance, your history, and all that. So down here you have other extra tools like exposure. So exposure gives you access. So I'm just going to get rid of this lower section down here. So these are just extra tools we wouldn't be using right now. So exposure gives you access to tools that tells you how much risk your account is exposed to when you carry out trades. So right now it's blank because there's no trade running in our account. Okay, so you can, however, go through all the different sections down below to see the different information they provide you if that would be useful for your trading. Okay, so let's say, for example, for the Euro USD, in order to open trades, all you have to do is click on sell. So this is the sell button here, or click on buy. That's in order to predict that the market is going to increase, the exchange rate of areas is going to go increase in value or decrease in value. So this is just a quick tool to help you get into trades quickly as possible. So another option to open trades is by clicking on this new order here. So if you click on new order, you are going to get something similar to what we had in the mobile view, where you get to select type of trade you want to open. If you're going to open a pending order, or you're going to open a market execution. So by default it's on market execution. Okay, so you can see our currency pair is Euro USD. So if you click on this, you can choose a different currency pair from this section. Okay, so this section gives you access to different currency pairs or different metals or different trading instruments you wish to trade. So for now we are trading Euro USD, for example. Then market execution or pending order. So if you click on pending order, then you get the option to choose your buy limit, sell limit, buy stop or sell stop. So for now I'm going to take it back to market execution. So market execution means you are going to get into a trade immediately at the current market price. Okay, so here you choose your lot size. Remember I said one lot simply means 100,000 units worth of currencies. Okay, so in this case for Euro USD, if you put in our one lot, it shows you 100,000 euros. Why? Because euro is the base currency in this currency pair. So one lot, 100,000 euro. So if you put in 0.1 lot, so this is what I was trying to explain in our previous lesson. So if you put in 0.1 lot, so 0.1 lot gives you 10,000 units worth of currencies. So in this case euro. So I'm going to go over to another currency pair. So let's say we are trading USD JPY. Okay, so I'm going to search for USD JPY. So this USD JPY, let's say we're going to trade USD JPY. Now if you put in one lot, you see it shows you 100,000 US dollars. So this is the quantity of this currency you are willing to get into this trade with. So a one lot means 100,000 units, 0.1 lot means 10,000 units, and 0.01 lot means 1,000 units. So you can also go for 10 lots, which is 1 million units. So you can see in this case 1 million US dollar, because we are trading the US dollar Japanese yen. So that's basically a breakdown of how to execute trade or how to carry out trade. So that's a brief summary on how to open trade and check out your balance. So over here you have your various currencies. Okay, so this is a list of different currencies you can trade right now. So in order to add new currency, all you have to do is click on add currency. Then let's say you want to add Euro CAD. So simply search for Euro and you get a list of all the Euro pairs. So you can see Euro CAD and you just click and you have Euro CAD in the list over here. So in order to change this chart you are seeing on the screen right now, this is called a chart. All you have to do is drag the currency pair you wish to watch and place it on the chart, and it simply changes to the currency pair you just drag and drop. So I know it looks foreign right now looking at this chart and this green stuff on the screen. I'm going to explain what this means as we move forward with the academy. It's easy. I'm going to help you understand how it works, so it doesn't look foreign to you, or it doesn't look like some sort of difficult stuff. It's just easy and you're going to get it. So this is basically it for the desktop version of the MetaTrader 5. I really don't trade with the desktop version. I stick with the mobile version. So that's it, guys. If you have questions, use the question section at the end of this course, and don't forget to take the quiz. So just a quick summary before we round up this course. We talked about the MetaTrader 5 and how to utilize the MetaTrader 5 platform on both the mobile version and the desktop version. Okay, so for both Windows, for Mac, for Android, and for iOS. So for this recap, I'm going to start with the mobile version. So what we do is we just come here and download whichever of the software we need for our mobile. So if you're using an Android phone, click on the download button for Android, and for iOS, simply click on the download button here. Okay, so now I'm going over to our MetaTrader 5 on our mobile phone. So all we have to do is click and it opens. So in the first section we have the quotes. This is where we have a list of all our currency pairs, and to add a new currency pair, all you have to do is click on the search bar and simply write out any currency pair you would like to trade on. So I'm going to try Euro NZD, for example. Okay, so yes, Euro NZD, you click on the green plus icon and it's automatically added to our list of currency pairs. So you can do the same for commodities. You can add crude oil, you can add gold, you can add Brent oil, you can add whatever currency pair you wish to trade on your MT5 platform. So on the next section, so we're talking about the navigation bar at the bottom of the application right now. So at the bottom section, you click on charts, which is the next. Then you get a chart which shows us the price movement of the exchange rate between whichever currency pair you're watching. So I'm just going to go over to quotes once more. So let's say, for example, we want to watch the real-time price movement of the exchange rate between Euro and USD. All we have to do is click on Euro USD. Then a list of options pops up and we click on chart, and then we get a chart for Euro USD. So this shows us the price movement of Euro USD in real time. So in order for you to open a trade, so go for a buy trade or go for a sell trade, all you have to do is come to the quote section. So check out the currency you wish to trade, or let's say, for example, gold or Euro USD. For example, if you click on Euro USD, click on trade, then this section pops up. So here you have the market execution. You can go in with various lot sizes. Okay, so remember, one lot simply means 100,000 units worth of currency. Stop loss simply means an automated price target where you want the MT5 software to automatically help you close your trade when you run at a loss. While take profit is a level that helps you automatically close the trading profits when you are not around or you're off the charts. So you can click on sell by market or buy by market. So sell by market simply means you're opening a sell trade, which means you are predicting that the exchange rate between Euro and US dollar is going to decline in value. While a buy by market simply means the trade is going to be open immediately and you are predicting that the exchange rate between Euro and USD is going to increase in value. So you also have what we call the pending orders. Okay, so buy limit, sell limit, buy stop, and sell stop. So those are pending orders to automatically set up trades that will trigger when you're not online. So in order for you to log in your account, so before we talk about trades real quick, let's talk about how to log in your account. So when you click on settings, you click on new account, then you can search for your Forex broker if they are available on MT5, and you search for them. They pop up. Click on server, put in your login details, and hit the login button, and you are there. So next we'll talk about the trade section. So this is where you get to monitor your trades, you get to modify your trades, close your trade, and so on. So you have your balance. This is your total deposit or your total funds available for trading. So your equity is simply the running trade minus your balance, or the running trade, total running trade plus or minus in addition to your balance. So right now there's no running trade. That's why our equity is the same as our balance. So we also have the free margin, which means no funds has been set aside from our account right now to open any trade. So that's why our free margin is at 975. So whenever we open a trade, a set of funds is kept aside to run such trades, and they are deducted from our balance, and then you have a certain amount of free margin, which is the funds available in your account to open a new trade. So the history section is where you get to manage your trade. So as you can see, the $70 we made and the $95 we lost is there in our history. So a history is a breakdown of your total trades, your entry, your exits, and all that. So if you click on the search rate, for example, you get a breakdown on how the trade went through. Okay, so same with the buy trade, you see a breakdown how we lost our entry price and our exit price, or the price at which we closed the trade. So that's basically it for the mobile version, and we also talked about the desktop view. If anything is not clear, you can go back to that video and watch to see how the MT5 platform works on the desktop view. But I really think you would be trading with the mobile view because it's much more convenient regards to the functions you would be needing while you carry out your trades. So guys, before I leave you, just a quick note, okay? Most of the calculations we did in this course are not compulsory, okay? You don't need to carry out these calculations yourself, okay? This course was meant to help you understand how it works, so whenever you make profit or a loss, you know how those stuff were being calculated, or how the profit is being calculated, or how the loss is being calculated, so you don't get surprised by what you see on your trading account. And remember, for a $1,000 account, it's recommended to trade with 0.01 lot. So don't go over the moon trying to trade with 1 lot or 10 lots because you feel you could make $70 in just a few minutes. Okay, so that's not how it works. But as we move on with the academy, you are going to learn the reason why we advise or we recommend trading with the lowest risk possible. So you're going to learn all that when we get to risk management. So that's it for this course, guys. Don't forget to take the quiz, and if you've got questions, use the question section at the end of this course. Alright, before I show you a few more things, let me quickly walk you through how to join the academy and become my student. When you click on the link in the description below, you will land on the BraveFX website. Click Start Learning Today or the Join Now button. If you're on mobile, you will see an Enroll Now button. Right now, there's a 50% off. That's why you're seeing $49 instead of $99. This discount won't last forever. Click on the Enroll Now button and you'll be taken to a checkout page. Enter your name, email, payment info, and hit the complete purchase button. As soon as payment is confirmed, you get instant access to the academy, everything waiting for you on your dashboard, no delays. Before we continue with the lesson, there's a few important things you should know. When you join the academy, you get lifetime access to the complete Forex trading course. No monthly or yearly subscription, one-time payments, and you get lifetime access. I stand behind this course 100% that you're going to get the exact knowledge you need to become a skillful trader. But if for any reason this isn't the right fit for you, all you have to do is request for a refund within 30 days and you get every penny back, no questions asked. You can request for a refund simply by going to the support section in your dashboard and using this form over here. Select request refund, write a short message and hit send. That's it. You get a full refund within 3 to 10 business days. We've also got an active Discord community with thousands of traders. All you have to do is go to the community section on your dashboard, click here and you're in. This community is strictly for educational purposes only, so I share weekly market updates and insights. You can also ask questions, share your charts, and get feedback from fellow traders within the Discord community. And lastly, over 1,200 students have left reviews, and 450 of them with detailed feedback. You can check them out on our website, BraveFX.io. Real traders, real results. Join the academy today by clicking on the link in the description below. So this is the last section of the beginners class. In this section, we're going to be talking about TradingView, which is kind of like an introductory lecture to what to expect in the intermediate class. So here I'm going to be showing you TradingView. I'm going to be introducing you to the various tools in which we'll be using to carry out technical analysis, and as well as the best and most recommended platform for technical analysis. So this section prepares you for what to expect in the intermediate class, and it's all about an introduction to TradingView and the tools we will be using to carry out basic technical analysis when we get to the intermediate class. In this lesson, we'll be talking about TradingView. So what's TradingView? TradingView is simply a software or an application that provides traders with the tools needed to successfully trade the financial markets. So TradingView provides you with tools to trade the Forex market, the stock market, and even the cryptocurrency market. But since we're talking about the Forex market in this lesson, so we're going to focus more on the tools provided by TradingView to successfully trade the Forex market. Now, on the home page, you can see that we have the chart. So in order to access the TradingView platform, just simply go to tradingview.com. So that's their website. So when you get there, you get this homepage and you get to access all the tools basically for free. So you can, pay for premium packages or go for a pro package in order for you to access more tools and more, flexibility with trading. So now I'm just going to go through the homepage real quick. So this is the homepage and this is a market summary. So these indices, stock, crypto, forex, futures, and bonds. So they basically gives you access to all the forex markets, all the cryptocurrency market, stock market. They provide you with the tools and everything needed to successfully carry out trades in this market. So this is basically where we would be carrying out our technical analysis. So in the next class, because this is basically the last course in this class, so we're currently in the beginners class. So in the intermediate class, we'll be talking more about analysis. Okay, so this is what you would be utilizing in order to successfully trade the financial market, carry out your analysis. So those terms you hear, I'm talking about support and resistance, chart patterns, trend lines, market structure, price action, and all that. This is where those actions will be carried out. Okay, this is where you are going to learn to analyze the market from a technical point of view in order to successfully carry out trades. So in the previous courses, I talked about having a third-party platform where I carry out analysis because I don't like to trade on the MT5 desktop view, okay, the desktop trading environment. So TradingView is the third-party platform I was referring to. So it's swift, it's clean, and it's easy to understand, and it provides you with basically all the tools you need to successfully trade forex markets. Now, scrolling through the page, you can see lots of ideas. So users on the TradingView platform are allowed to share their ideas. They're allowed to, post stuff, get followers, get comments, get reviews from other users on the TradingView platform. But I'm not going to be focusing on that right now. So we're going to focus more on, how to take advantage of this tool provided by the TradingView in order to be a successful or a professional market analyst. Okay. So in order for you to access this TradingView environment, all you have to do is click on products and then you see charts. So you click on charts and you get access to the TradingView environment. But before we go there, something very important to mention is that you do not have to, sign up for an account in order for you to access these tools needed to trade the markets. Okay. So if you want to create an account, simply look for the sign up tool, create an account and log in to access your TradingView account. But you actually don't really need that in order for you to access the basic tools needed to trade the forex market. So right now you're not going to find the login button or the sign up button on this page because we are currently already logged in. So if you're interested in getting an account, you can simply go to tradingview.com, sign up, it's free, and then access the TradingView environment. So in order to access the TradingView environment, like I said before, all you have to do is click on products and you see charts. So when you click on charts, you get access to the TradingView environment. So this is the TradingView environment. As you can see on my screen, we have lines, we have numbers, we have a bunch of icons. So as we move on with this course, I'm going to explain what this means, okay? What everything you can see on my screen right now means. These lines, these numbers, the buttons. You're going to understand how to navigate through the TradingView environment and how to, take advantage of this tool to successfully trade whatever financial markets you choose to trade. So for now, we'll be focusing on Forex. So like I said earlier, it's free and you do not need to, go for a pro package or go for, higher packages. You can simply take advantage of the free version and get used to trading before, maybe upgrading to a higher package. That's if need arise. So that's it for an introduction to TradingView. I hope this helps. So in the next lesson, we'll be taking a deep dive on the TradingView environment and how to navigate and utilize the tools provided by this platform. In this lesson, we'll be talking about charts. So on my screen here, this is the TradingView environment as we talked about in the previous lesson. Now, this entire area you can see on my screen here. So I'm just trying to use my mouse to, mark out this entire area on my screen. Is known as the charting area. This is where we get to see a virtual representation of price movement over time. So that's what charts are. Okay, so charts are simply virtual representation of price movement over time. So this blue line you can see is known as the line chart, and every area on the screen you see this blue line simply tells us how high price has moved or how low price has moved over time. And this dotted line you can see on my screen simply tells us the current price. Okay, so right now the current price is at 0.99640. So on the right hand side, this is where the price of an asset is being displayed on the TradingView environment. So in this case, we're currently watching the Euro USD currency pair. So the prices we see on this right hand side is simply the exchange rate between Euro and US dollar. So right now the exchange rate is at 0.99640. So 0.99640 dollar is required to exchange 1 euro. So that's basically a quick review of the TradingView environment and the chart. And below here you get the dates. Okay, so on your screen, wherever you put your mouse on your screen, so on the line chart, looking at your far right and looking at the bottom, you get to see the dates at which that price occurred and the price at which the exchange rate was on that particular day. So once again, the chart shows us a virtual representation of price movement over time. The reason why this is important is because we need to, see how price has moved in the past in order to successfully carry out trade predictions for the future, and this is known as price action. So as we move forward with this academy, you are going to learn everything there is to know about price action. So price action is a strategy, is a way of analyzing the market from a professional point of view in order to successfully carry out trades. Now, there are different types of charts, okay, with different interpretations. Looking at the line chart, we can't really deduce much on what's currently happening in the market or how to take advantage of this market or how to enter a trade and so on, because it's basically just lines. All we can see from a broader sense is that we know that, okay, from this level to this level, price increased in value. So if you take a look at the value of price when the value of the exchange rate when it was at this level, you see it was at 1.04022, and if you should put your mouse at the top here, you see it was at 1.25061. So this tells us that price actually moved, or the exchange rate between euro and US dollar actually moved from this level to this level, increasing in value. And you can also use the same logic to state that the exchange rate between euro and US dollar declined from this top here down to this level, and also rose again and now declined to these levels. So this is basically how you can interpret charts and why charts are important. So logically you can say, okay, there's a probability that price is going to increase again up to this level, but that's just based on assumptions. So we're going to teach you how to successfully carry out analysis, so you don't carry out trades based on speculation, based on guesswork. So there's a way these things work. So that's why as traders we don't usually trade with the line chart. So this is known as a line chart. In order for you to access other types of charts, all you have to do is come to this section, this icon section, and click. Then you see there are different types of charts here. So all these charts here shows us the same information. Okay, they are meant for the same purpose, to show us the price movement over time. Okay, the past price movement over time. That's what these different charts does. But it's left for you to understand how this chart works and the information they present in order for you to successfully carry out your trades. Now, the most popular chart type you come across on the internet, or for most traders, is the candlestick chart. Okay, so this is the candlestick chart. They are known as the Japanese candlestick. Here they show us a ton of information. Okay, each candlestick on this chart shows us a ton of information that can actually tell us how to open a trade, how to close the trade, when to open a trade, when not to open a trade, and how the market is looking. And you are going to learn all these as we move forward with the academy. So just a quick breakdown. This stuff you can see on my screen right now known as candles. So this red one is known as a bearish candle. Okay, so I'm not going to go in with the big terms right now, but as you move forward with the academy, you're going to learn on that. So this is a candle, this is a candle, this is a candle. So each individual green box or green line you can see on my screen is known as a candle. So just a quick summary before we move on to the next lesson is that this green candle means price moved from here up to this level. Okay, a green candle simply means the area in which price rose. Okay, it shows us an increase in the value of the exchange rate between euro and US dollar. A red candle shows us a decrease in the value of the exchange rate between euro and US dollar. This is just a quick intro. We're going to go deeper into these candlesticks because they are really, really important as you move on with your trading career. So that's basically it about charts. Just a quick summary. On the far right here, you have the exchange rate between whatever currency pair you're watching. If you're watching gold, for example, the value of the gold would be displayed on this right hand side. If you're watching a stock, the value of your stocks will be displayed at this right hand side. And on the chart here, the chart shows us the virtual representation of price movement over time. So you can zoom out, you can zoom in. So with this minus and plus button, you can rearrange the chart by using this circle. So you can shrink, you can do basically anything on the chart. You can move around as it suits you, which from whatever view you would like to see the chart from. So you can zoom in, zoom out rather. And once again, looking at the chart, you can see clearly that price, the chart shows us that price declined from these levels down to these levels. Okay, and with these little information and candlestick you can see on my chart, we can actually deduce price levels at which we can open trades, close trades, either buy trades or sell trades. Okay, so with this information we can predict the direction in which price is headed. So as you can see on my screen, price has been declining from this level down to this level. So you can see at each particular level, you can see an opportunity to take a sell trade, sending price downwards. So we're going to talk more about this chart. We're going to talk more about how to analyze charts. We've basically not done any analysis right now. So this is just a breakdown of how chart looks like. So to take a quick look at the other types of charts, so you have the bar chart. So these somewhat different from the candlestick chart, as you can see. So I just zoomed in now. So you can see they look different a bit from the candlestick. So some traders prefer to use this type of charts, but I don't use the bar chart. Okay, I prefer the candlestick chart. So you also have the baseline chart. So this is another type of chart that shows us areas in which we could potentially open a buy trade or open a sell trade. So you have so many charts here. You have the Renko. So these are different chart types. So this looks a bit like the Japanese candlestick, but it's quite different. So the most popular chart type that most traders prefer to use because it's easier to interpret and it gives us clear information on what's going on in the market is the candlestick chart. So the full name is known as the Japanese candlestick. We are going to have a special course to teach you everything about candlesticks, Japanese candlesticks, and how to interpret what these red candles and these candles means. Okay, so that's basically it for charts. In the next lesson, we'll be taking a look at trading tools. So in this lesson, we'll be talking about trading tools. Now on my screen here, we can see we have the candlestick chart, which we have explained in the previous lesson. Okay, so we give a brief intro into what the candlestick charts are. Charts in general are a virtual representation of price movement over time, which gives us insights as to where price might be headed in the future in order to take great trade opportunities. Now, speaking about trading tools, on the left hand side of my screen is where you have all your trading tools. So this is the section where you have your trading tools. So what exactly are trading tools? Trading tools are simply a set of technical tools that lets you carry out analysis. So you can mark out an area on your chart, you can set up levels, you can set up alerts, and so many things. So I'm just going to go over the most important trading tools one at a time in order for you to understand what I'm talking about. So up here, we have the first trading tool, which actually helps us navigate through the chart window. Okay, so we have this cross. So this is what it means. So you can see as I move my mouse on the screen, it shows as a cross, which shows us the area on our chart where we have the price and the date at which those price occurs. Okay, so at the bottom we have our date, on the right hand side we have the exchange rate or the price of whatever you're watching. So if this cross seems too much for you on your screen, you can simply change to something else. So a dot, for example, it's basically the same thing. So I'm going to try another one. So an arrow, for example. So you see you've gotten rid of those horizontal and vertical lines. So you just have the pointer, and on your right hand side you have the exchange rate. At the bottom you have the date. So if the cross seems too much for you, you can use the arrow, and there's also an eraser as well. So I don't know why they did this, but that's just what you have for the navigation cursor in order to change that. So on this section you have lines. Okay, so you have trend lines, you have arrows, you have rays, you have horizontal rays, you have all sorts of lines, you have parallel lines, you have all sorts of tools here to enable you carry out your chart analysis or your market analysis. So just a quick view of how the trend line looks. So I'm going to click. So when you click on the trend line, it actually helps you mark out area of your charts where you would like to watch price get to in order for you to carry out trades. So let's say, for example, you pick the trend line. So now you can see that it's slopey. So it helps you mark out an area on your chart where price has repeatedly declined with time. So you can see on this level, price decline, on this level decline. But these are just basic tools and basic information about what these tools are used for. But in the next class, or in an intermediate class, we're going to having dedicated lessons to help you understand how these tools work fully. Okay, so that's just basically it for the trend line. So it helps you mark area of trends on your chart. Don't worry about what trends are. We're going to explain what trends are. Okay, so moving on, you have a parallel line. So this is to, get two parallel lines, two parallel trend lines. Okay, so you can draw this in another way. So it can be horizontal, but just two lines parallel to each other is what this tool is all about. So there are a lot you can use this for. So moving on, we also have, let's see, so we also have the arrow. So if you want to draw an arrow on your chart, this is just the tool. You see it has a pointed arrowhead. So these are just basic line tools needed to carry out analysis, and you will see the reasons why we need these tools as you move forward with the academy. So we have horizontal lines. So this horizontal line cuts across the entire chart. So if you should scroll back, you see that the horizontal line on your chart cuts across the entire chart. Okay, so if you don't need a line that cuts across your entire chart, you can also make use of the horizontal ray. So this one just helps you mark out a specific area. So you see it starts from this point and goes straight down to the right. So this doesn't cut out the entire section of your screen, and it's a bit neat when compared to the other one. So there are also a bunch of tools here. That's basically the most important one. So you can also make use of a vertical line to set price targets and so on. So that's it for lines. So we have the Fibonacci retracement. So the Fibonacci retracement is a tool that helps you mark out potential price reversal levels, okay, or price retracement levels. Don't worry about that. We're going to explain what Fibonacci retracements are. There's a specific and dedicated course for the Fibonacci retracement. Okay, so you're going to learn what that means and how you can take advantage of this tool. It's a very important tool that's going to be a great add to your arsenal in order to carry out a successful trade analysis. So we have the brush. So you have the brush in order for you to write stuff on your screen for reference purpose. So that's there. We also have the rectangle. So you have rectangle, so you can mark out areas on your chart like this. You can shrink the sizes, make it however you wish to make it. So these are just a quick rundown on the available tools. Okay, I'm not going to explain what each tools are meant for. I'm just showing you what's available, and as we move on with the next class, we are going to use these tools. So this is the arrow pointer, so you can use to mark an area on your chart. You can use it to mark out important levels, or let's say you're explaining a chart analysis to friends. These tools will come in handy for you to help them understand your view of the market. So you have the eclipse. So this is something like this. So whichever tool you need to carry out analysis to mark areas on your chart, you got them all on the TradingView platform. So this is a triangle. So however way you need the triangle to be shaped out, you can mark that out on your chart with this triangle tool. So that's it for triangles. That's it for most of those tools. Let's see what we've got here. So that's basically the most important tool I think you will need. So you have curves as well. So I don't know why you would need this, but if you do, the tool is available for you. Okay, so you have text, you have notes, you have tweets, you have ideas, you have call outs. So you have arrows. So you can do basically almost anything on the TradingView platform. Whether you're going to teach your friends how to trade, you are going to make reference to your charts, you are going to publish an idea. So yeah, this something very important to mention is that one of the major reasons why these tools are available is because you can see this publish button right here on my screen. So you can actually carry out a chart analysis using these tools to identify levels, to mark out levels, and then publish. So when you publish, it goes into the TradingView system. Okay, it goes into the TradingView network, so other traders can as well see your published analysis. So it's easy for them to understand what you're talking about or what you're explaining on your charts. So that's one of the reasons why these tools are made available, in order for you to successfully carry out analysis and explain to other viewers or explain to your audience why you carried out such analysis and the important levels you're watching out for, why you are going to take a buy trade or take a sell trade, and so on. So you're going to see more reasons why it's important, because as I carry out analysis, in order for you to understand some certain price levels and concepts, I'm going to be using these tools to explain what those things means. Okay, so you also have price range. So I talked about how to calculate pips in our previous courses. So you can actually use this price range to calculate pips. So let's say, for example, you open a buy trade at this level. So a rise to this level gives you 177 pips. So you can see that here. So this tool helps you calculate your pips without having to do all the tedious maths. Okay, so let's say, for example, you take a sell trade at this level. I'm just going to put this here. So you take a sell trade at this level, so at this top here. So you can use this tool to measure your pips. So if you close your trade at this level, that's 1000 pips on Euro USD. So that's basically what this tool does. And if you check here, you have a bunch of other tools you could use to carry out your analysis or use to explain to your friends what you are watching on the market. So that's basically it about the tools. Just to go over it once more, you have the cross, which helps you navigate through the chart section. Then you have lines. So you have trend lines. So these are slanty lines. You can draw them however you wish to, however it suits your chart, in order to successfully carry out trade. So these can help you actually develop a trading strategy, and we're going to teach you all this as you move forward with the academy. Okay, so you also have the channels. So channels are also going to help you develop great trading strategies, and you're also going to learn this as you move forward with the academy. Okay, so something also important to note is that we have the horizontal line. I know you might think, okay, what would I possibly use an horizontal line for? When you get started with trading, when you start hearing concepts like support and resistance, these horizontal lines are going to come up handy in order to successfully draw out great support and resistance levels, which is one of the most important trading concepts you are going to make use of throughout your trading career. So that's basically everything about tools. In the next lesson, we're going to be talking about indicators, which is another set of trading tools to help you take advantage of the financial market. In this lesson, we'll be talking about indicators. So indicators are simply a set of tools, or I'll call them trading softwares, that add a very big advantage to your trading analysis. Okay, so these indicators are made up of some set of raw data information from the market to give you an edge over the price movements, whether in the forex market, in the cryptocurrency market, or in the stock market, in order to help you carry out great and suitable technical analysis. So that's it about indicators. So there's a few indicators we'll be taking a look at today. So I'm going to just name a few and show you how to add them on your chart. So we're not going to do anything serious, just a few list of indicators, because as you move forward with the academy, you are going to be learning a lot about indicators. So we're going to teach you a few. There are quite a lot of indicators out there. So there's about over 100 indicators out there, maybe thousands, but learning how to use one or two or three good indicators in accordance to your trading style would give you a huge boost and a huge edge over the forex market to give you better trade results. Now, a few indicators you're going to come across as you move forward with our academy is the moving average. Okay, so moving average are very important to follow trends. Don't worry about that. We're going to teach you what trends are. We have the RSI, which shows you the strength of the market. Okay, whether it's being overbought or being oversold. Once again, we're going to teach you what this means. You also have the MACD and a bunch of other indicators. So we're going to teach you a few important indicators, and you don't need to learn all of them, okay? So you can learn a few, maybe one or two, and add them to your technical analysis to help you get better trade results. So in order to add indicators to your chart, all you have to do is come to this section. So up here in your TradingView window, so the TradingView environment, you get indicators. When you click, all you have to do is search for the indicator. So in this case, I'm going to search for relative strength index. Okay, that's RSI. So it pops up and you just click and it's automatically added to your chart. So that's what you can see at the bottom of the screen. I don't want you to worry about these lines or what they mean. As you move forward with the academy, you are going to learn a bunch of this stuff. It's easy, it's not difficult. It might only seem difficult because it's probably your first time hearing these names or these tools, but I'm going to teach you how to utilize and take advantage of these tools and how to incorporate it with your trading plan, your risk management, your trading style to give you better trade results. So another indicator, for example, is the moving average. So you have to do is click on the indicator section, then search for moving average. So you click on moving average and it's added to your chart. So this blue line within your chart, and you can also tweak the settings. So you click on the settings icon here and you can make changes to the moving average. So I'm going to show you how and what kind of changes you would expect to make on whichever indicator we are we'll be teaching you, and how to take advantage of this stuff. So that's basically about indicators. So just a quick rundown. Indicators are simply trading tools or software made up with raw data from the market to give you an edge over the forex market. So it's not dedicated to just the forex market. So you can use these tools for the stock market, the cryptocurrency market, and all that. And all the technical analysis I'm going to be teaching you in our academy as you move forward is going to be good enough to trade whatever financial markets you choose to trade, from a technical point of view. So that's it for indicators. In the next lesson, we're talking about time frames. In this lesson, we'll be talking about time frames. So this is going to be a simple, basic introduction to what time frame means when it comes to trading. One of the reasons why, trading time frame is important is because it gives us a wider view of price movement over a long period of time. Okay, so we can decide to view the market from a period of 5 minutes. We can decide to look at the market from a period of 1 day, 1 week, 1 month, even years. Okay, so right now on my screen, just to show you an example of what I'm talking about. So on my screen, this chart starts from March 2020. So I'm going to show you what I'm talking about right now. So looking at the bottom of the the chart, you can see that it gives us the date. So this is 2022. So right from here down to this level is 2022. Okay, so I'm going to use the horizontal line to mark out these levels on the chart. So this is January 2022. So the price movement from this level to this level is basically what has happened in 2022. Okay, so now I'm going to mark out 2021. So this is January 2021. So looking at the bottom of the screen, you can see the dates. So the whole of 2021, price moved from here to this level. I think you're starting to get my point now. So if you take the chart back like this, you can see this 2020. Now I'm going to mark that. So from this horizontal line to this horizontal line is what happened on the Euro USD trading pair the whole of 2020. Okay, so from January to December 2020, this is basically what happened, the price movement. Okay, I'm going to zoom in so you can see this clearly. So this is from January 2020 to December 2021. So from January 2021 to December 2021. So from January 2022 to present day, so that's August 26th. Okay, now if you look at this closely, let's say for example we were to go back to 2001, you would have to screw so hard and so far back before you get to 2022 or 1995 as the case may be. You can also use this button to zoom out. So even if you zoom out, you are still not going to get as far as 1990, or the chart is just going to look a bit messy. Okay, but what you can do is you can use the time frame tool to adjust the size of the chart, so it's easy for you to see price movement dating back as far as 1995 or even 18 something, as far as the data can give us on the TradingView platform. So I'm going to get rid of this indicator right now. This is the RSI, so I'm going to get rid of it because we don't need it. So what you can do is come to this section. So this is known as the time frame section. So you can see this is the time frame for days, and this is the hourly time frame, and this is the minute time frame. So in order to go back, let's say we set our time frame to 1 week. Now it helps us shrink the chart, so you can see right now we can go as far as 1976. So you can see at the bottom of the chart 1976, and I'm going to explain the reason why this looks like this right now. So this way back to 1976, if we didn't adjust the time frame to 1 week, there's no way we would have been able to screw so far back ahead to check out the price action from 1980 or 1976. So something interesting that you will notice is that right now 2022 to 2021 and 2020 now looks so tiny on the chart. The reason is because when the time frame is adjusted to 1 week, it means each candle on my screen right now on the chart takes 1 week to form. Okay, so the formation of each candle right now on the chart takes 1 week to form. So this green candle you can see right here, it took it 7 days to form this candle, or 1 week, one trading week to form this candle. Whichever candle, however small, so like this candle for example, it takes it 1 week to form this candle. That's why you can see now it's showing us that this from this level to this level happened in the whole of 2020. So from here to this place is January to December 2020. So from this level to this level is January to December 2021, and from this level to this level is January to August 2022. So if I should adjust the time frame now to, let's say, 1 month, you will see how tiny it makes it look. So this means from here to this level is the whole of 2021. So let's try to count how many candles now we can see in this space. Okay, so we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So the reason why we have 12 candles here is because we have 12 months in 1 year. So the time frame right now is showing us it's on 1 month. So this means it takes 1 month for each candle on the screen to form. So the formation of each candle on this chart right now is 1 month. Okay, so it takes 1 month for each of these candles to make their formation. Now the reason why this is good is because it gives us the opportunity to get a clearer view of the market without having to distort the chart or make the chart look really messy. So right now you can see this is from 2000, so you can see the entire price action right from 2000 or 2001 to current date. So you can see it's neat, it's clean. So that's the beauty of learning how to adjust time frames. So you cannot just go ahead and start adjusting time frames to start taking trades. There are techniques to trading on different time frames and how to navigate through time frames, and there are specific advantages you get over the forex market if you really understand how to carry out analysis on multiple time frames. So let's say for example we're trading Euro USD. On a monthly time frame we could get a signal to go long. On the weekly time frame we could get a signal to go short. So going long simply means taking a buy trade, and going short simply means taking a sell trade. So understanding how time frames work and with the candlestick gives you a edge over the forex market, gives you the opportunity to analyze the charts, carry out trades for better trade results. So you can also go as low as minutes. So I'm going to put this in 1 minute right now. So this is a 1 minute chart. You see the charts are so tiny. Why? Because they are made within minutes. So each candle you see on my screen is made within a minute. So this is a 1 minute candle. It takes 1 minute for this candle to form. So the market is not moving right now because this video is being made on a weekend. So today is Saturday, that's when I'm making this video. So that's why the prices are not moving right now. So as we move on with the academy, I'm going to show you a real example of how price moves on different time frames. So time frame analysis is something we will talk more on as we move forward with the academy. Okay, we're going to have a dedicated course to help you understand how to navigate through different time frames and how to take advantage of the forex market using multiple time frame analysis. So that's 1 minute time frame. So I'm going to go back to, let's say, the 1 day time frame. So the 1 day time frame simply means each candle you see on the screen right now takes 1 day to form. So it takes 1 day to form an entire candle right now. So what this also means is, if I go down to the 1 hour time frame, for example, it means each candle here will be broken down into 24 different candles. Why? Because we have 24 hours in a day. So that's it about time frame analysis and how to analyze charts on different time frames. Okay, as we move on with this academy, we are going to do a deep dive into all these and explain properly so you can understand how it works with trading in general and how to take advantage of these concepts in order to generate great trade opportunities. So that's it for this course. In the next lesson, we'll be having a brief summary on everything we've discussed about TradingView and an intro to technical analysis. So just a brief summary of this course. We talked about TradingView, which is a software that provides traders with the tools necessary to successfully carry out technical analysis on the forex market, the crypto market, the stock market, or any other financial market you could think of. So in order to sign up, you could just click on the sign up button, create an account, and there you have it. And you also have to understand that you do not need to create an account to utilize the charting software provided by TradingView. So in order to access the charts, all you have to do is click on products, then click on charts. So when you click on charts, you get transferred to the charting software. So this is your TradingView environment. On my screen here, you can see this is a candlestick chart. We talked about this briefly. You can also change to different chart types to help you navigate through the forex market. So this is a line chart. You have the area chart. You have all sorts of charts here, but the most popular chart that I understand fully well, that I think most traders prefer, is the Japanese candlestick chart. So on this chart, the green candle means an area where price rose in value, and the red candle means an area where price decline in value. So at the right hand side is the exchange rate between Euro USD or the price of any asset you are watching. So at the bottom we have dates. So with the cursor, you can see that whichever part of the chart you point your cursor, it gives you a direct date and the price Euro USD was on that particular day. So on the left hand side, we have the tools. You have the different horizontal tools, trend lines, channels, and all that. You have the Fibonacci retracement tool. You have the brush and all sorts of other tools and shapes here you could take advantage of in order to carry out your technical analysis. So we also talked about indicators. So indicators are software that are made up of data from the financial market to give you an edge over the forex market or whichever markets you are trading on. So that's it. In order to add indicators, simply search for whichever indicators you want to add. Let's say RSI, so relative strength index. You click and it's automatically added to your chart, and you can start taking advantage of this indicator to create great trade opportunities for yourself. So that's it for indicators. Then we also talked about time frames. So time frames let us get an overview of the market from a larger time frame perspective. So we also said the weekly time frame means each candle on the screen here or on the chart takes a week to form. Okay, so the formation of individual candles on the chart takes 1 week to fully form. So if you go to the daily time frame means each candle on the screen here on the chart takes 1 day to fully form, and this dotted line is our current price for the Euro USD or whatever asset you are watching. So that's basically it about the TradingView and how to get started with trading. So this is where we will be carrying out our technical analysis as you move forward with the academy. Okay, so all your trading concepts like support and resistance, chart patterns, trend lines, market structure, and all that, this is the trading environment in which we would be carrying out our technical analysis in order to successfully predict and develop trade setup in order to make profits from the forex market. So that's it for this course. If you have questions, guys, use the question section at the end of this course, and also don't forget to take the quizzes. It's going to help you a lot. All right, that's it for the Forex Trading Beginners class. You made it. your Forex trading account is fully active, and you understand the basics of Forex trading. But here's the reality. Everything you just learned isn't enough to make you become a professional trader. You need an actual trading system, which includes how to analyze various markets, when to enter a trade, when to exit, how to read chart patterns, risk management, trade management, and the trading psychology you need to stay profitable. That's what my Forex Trading Academy teaches. Everything you need to go from being a complete beginner to a professional trader. There's over 20 hours worth of content, 220 plus videos, all simplified step by step. I've laid out the complete roadmap, building a reliable trading strategy, managing your risk properly, and developing the mindset that separates winning traders from losing traders. If you're serious about becoming a professional trader, join over 6,000 students in my academy today. Use the link in the description below to get up to 50% off. I hope to see you inside.